Let's start with the obvious question that brought you here. The world feels unstable right now. Maybe it's a conflict that's been dominating the news for months. Maybe it's the kind of geopolitical tension that makes experienced diplomats visibly uncomfortable in interviews. Maybe it's the fact that defense spending is climbing in countries that haven't increased their military budgets in decades, or that commodity prices are doing things that commodity prices do when large portions of the world's supply chain run through active conflict zones. Maybe it's just the general ambient sense that the international order that defined the post-Cold War era is under more stress than at any point in most people's living memory. Whatever the specific trigger, you're here because you're worried about what all of this means for your money. And that's not an irrational thing to worry about. Wars have historically produced significant economic disruptions. They've caused market crashes, currency collapses, supply chain catastrophes, energy price explosions, and in extreme cases, the kind of capital destruction that makes the phrase long-term investing feel like a cruel joke told by someone who didn't live through it. So the concern is legitimate. The question is whether the concern should translate into action, and if so, what action and how much of it and in what direction. Here's what this video is going to do. It's going to give you the honest, evidence-based, historically grounded answer to that question, not the fear-driven answer that financial media generates when conflict headlines are selling advertising, not the everything will be fine, just buy index funds and don't look at it answer that ignores the genuine complexity of investing during periods of geopolitical stress. The real answer, which as you'll discover, is more nuanced than either of those polls and more actionable than both. We're going to look at what actually happens to markets during wars and geopolitical conflicts. Not what people fear happens, but what the historical record actually shows. We're going to look at which asset classes have historically provided protection during conflict periods, and which have provided the illusion of protection while quietly destroying returns. We're going to look at the specific portfolio adjustments that are worth making, and the ones that feel prudent but are actually just expensive reactions to fear. We're going to talk about defense sector investing, commodity positioning, currency considerations, geographic diversification, and the psychological dimension of investing when the news is actively trying to terrify you. And we're going to do all of this without pretending that investing during wartime is simple, while also not pretending that it requires you to become a geopolitical analyst with a PhD in international relations and a subscription to 3 different intelligence briefing services. No bunkers. No gold coins buried in the backyard. No panic. Let's go. Chapter 1. What history actually shows about markets and wars. The data will surprise you. Before we talk about what to do with your portfolio during wartime, we need to establish what actually happens to markets during wars, because the popular assumption and the historical reality are so different that getting this wrong will lead you to make exactly the wrong decisions. The popular assumption, wars are catastrophic for stock markets. Conflict destroys economic activity, disrupts supply chains, creates uncertainty that investors flee, and produces the kind of sustained downturns that wipe out years of portfolio gains. Therefore, the rational investor response to escalating geopolitical conflict is to reduce equity exposure, move to safety, and wait for the situation to resolve before reinvesting. The historical reality, considerably more complicated and for long-term investors considerably more encouraging than that narrative suggests. The initial shock and the rapid recovery. Here's the pattern that appears with remarkable consistency across major conflict events in market history. Markets typically sell off sharply in the immediate period around the onset of conflict, the moment when uncertainty is highest and fear is most acute, and then in most cases recover and continue their long-term trend within a relatively short time frame. The attack on Pearl Harbor in December 1941, as shocking and destabilizing an event as the 20th century produced, caused the Dow Jones to fall approximately 3% to 4% in the immediate days following. Within a few months, the market had recovered. Despite the United States entering the most devastating conflict in human history, the stock market spent most of World War II trending upward. By 1945, equity investors had experienced strong returns over the war period. The Korean War outbreak in June 1950 caused a sharp, immediate decline. The market fell roughly 12% in the days following North Korea's invasion. Recovery took approximately a month. The subsequent market performance through the conflict was positive. The Cuban Missile Crisis in October 1962, arguably the closest the world came to nuclear war during the Cold War, produced a market decline of approximately 7% before recovering fully within weeks of the crisis's resolution. The 1973 Yom Kippur War and the associated Arab oil embargo produced a more sustained and damaging market impact. U.S. stocks fell substantially in 1973 and 1974, but this was driven less by the conflict itself than by the specific economic mechanism of the oil embargo, the supply disruption to a commodity that the entire U.S. economy was structurally dependent on. The war was the trigger, the energy price shock was the actual damage mechanism. The Gulf War in 1991 followed the now familiar pattern: sharp decline in the months of uncertainty before the conflict began. Sharps. Recovery. Once the conflict's scope and duration became clearer, positive market performance through the conclusion. The September 11th attacks produced the largest immediate shock in modern U.S. market history. Markets were closed for 4 days and fell approximately 7% on reopening. Within a month, the decline was fully recovered. The subsequent decade of poor market performance was driven by the dot-com bust and the 2008 financial crisis, not by the geopolitical environment created by September 11th. The Russian invasion of Ukraine in February 2022 caused significant market volatility, particularly in European markets and commodity prices. But U.S. equity markets, after an initial decline, continued to be primarily driven by domestic factors: interest rate policy, inflation, and technology sector dynamics, rather than by the conflict itself. The pattern and its implications. What explains this pattern? Why do markets, which are supposed to be forward-looking discounting mechanisms, seem to sell off at the moment of maximum uncertainty and then recover relatively quickly even when the conflict continues? Several mechanisms work together. First, wars typically don't destroy the productive capacity of the economy of the country whose stock market you're investing in, particularly if you're investing in markets geographically distant from the conflict. A war in Eastern Europe disrupts European supply chains and energy markets, but doesn't prevent American companies from selling software, healthcare services, and consumer products. The economic engine keeps running. Second, wars frequently stimulate economic activity in specific sectors: defense, energy, materials, industrials, that partially offset the drag from uncertainty and disruption. Government defense spending is a genuine economic stimulus. The productive capacity redirected to military output generates employment, corporate revenue, and economic activity that partially compensates for the disruption elsewhere. Third, and perhaps most importantly, the market's immediate sell-off at conflict onset typically prices in a significant negative scenario. When the actual negative scenario unfolds and turns out to be bad, but not catastrophically bad in the feared way, the market recovers because the reality is less negative than the priced-in expectation. Markets move on surprises, and wars that unfold roughly as expected produce less sustained market damage than wars that produce economic surprises of the oil embargo variety. The exceptions that prove the rule. This pattern, initial shock, rapid recovery, has genuine exceptions that are worth understanding, because the exceptions identify the conditions under which wartime investing truly is dangerous. The exceptions cluster around situations where the conflict produces a sustained, structural economic disruption rather than a temporary shock. The 1973 oil embargo is the paradigm case, a supply disruption to a commodity so central to the economy's functioning that the entire cost structure of the economy was disrupted for years. The markets didn't recover quickly from this because the underlying economic damage, stagflation, energy-driven cost increases, structural economic adjustment, was genuine and sustained. World War II in Europe produced devastating losses for investors in German, French, Italian, and Japanese markets, not because the conflict created temporary uncertainty, but because the physical and institutional destruction of those economies was profound, and the political reorganization that followed fundamentally changed property rights and capital ownership. Investors in equities of countries that were physically conquered, occupied, or reorganized around fundamentally different economic systems experienced genuine permanent capital destruction. The lesson from the exceptions: the The relevant question for an investor is not, is there a war somewhere in the world? There almost always is. The relevant questions are, does this conflict directly threaten the productive capacity of the economies I'm invested in? Does it create a sustained structural disruption to critical economic inputs like energy or food? Does it carry a realistic risk of the kind of political and institutional upheaval that fundamentally changes property rights and capital ownership? If the honest answer to these questions is no, the historical pattern of initial shock and recovery is the more relevant guide. If the answer to any of them is yes, the calculus is genuinely more serious. The most dangerous investor behavior during geopolitical events. Here's the finding from the historical pattern that has the most direct practical implication. The investors who do worst during geopolitical crises are almost never the ones who stayed invested. They're almost always the ones who sold during the initial panic and failed to reinvest before the recovery. This matters because the initial panic sell-off, the period when selling feels most rational, when the news is most frightening, when the urge to protect the portfolio is most powerful, is precisely the period when selling is most likely to be a mistake. The recovery that follows, when it comes quickly and without warning. The investor who sold on the news and is waiting for clarity before reinvesting discovers that by the time clarity arrives, the market has already priced in the improved outlook and the recovery gains have been captured by the investors who stayed. This is not an argument to be cavalier about genuine geopolitical risk. It's an argument to be deeply suspicious of the urge to act that fear generates during conflict events, because that urge, historically, has led investors to make the specific decision that costs them the most money. Chapter 2. The asset classes. Who wins, who loses, and who just pretends to help. Not all investments respond the same way to wartime conditions. Understanding the historical behavior of different asset classes during conflict periods is the foundation of any intelligent wartime investing strategy, because the performance divergence between asset classes during conflict periods can be substantial, and knowing which direction each tends to move changes the portfolio decisions that make sense. This chapter is a complete tour of the major asset classes through the wartime lens, what the historical record shows, why it shows that, and what it means for your portfolio. Equities, the complicated case. We established in Chapter 1 that broad equity markets have historically shown resilience during most conflict periods, recovering relatively quickly from initial shocks. But within equities, the wartime performance divergence between sectors is significant and worth understanding in detail. Defense and aerospace stocks have historically been among the strongest performers during conflict. Escalation periods, the mechanism is direct and simple. Wars increase government defense spending, and defense spending is revenue for defense companies. Lockheed Martin, Raytheon, Northrop Grumman, BAE Systems, Rheinmetall, these companies' order books improve when geopolitical tensions rise and governments increase military budgets. The relationship between conflict escalation and defense sector outperformance has been consistent enough across multiple conflict periods that it's one of the more reliable sector relationships in geopolitical investing. Energy stocks, particularly those involved in oil, natural gas, and increasingly liquefied natural gas, tend to outperform during conflicts that affect energy-producing regions or energy transit routes. The mechanism, supply disruption, or the credible threat of supply disruption, causes energy prices to rise, increasing the revenue and profitability of energy producers. The 1973 oil embargo, the Gulf War, the Russian invasion of Ukraine, each produced significant energy sector outperformance coincident with the conflict's impact on energy markets. Commodity-exposed equities, mining companies, agricultural producers, fertilizer manufacturers tend to respond similarly to energy stocks when conflicts affect relevant commodity production or transit. The Russia-Ukraine conflict's impact on grain prices, given those countries' roles in global wheat and corn production, produced significant agricultural commodity price increases that benefited agricultural sector stocks. Consumer, discretionary, and technology sectors have historically shown mixed wartime performance that depends heavily on whether the conflict affects the domestic economic environment. In conflicts that produce significant economic disruption, inflation, supply chain damage, consumer confidence decline, discretionary spending and technology investment both suffer. in conflicts that are geographically distant and produce limited direct economic impact, these sectors often continue performing in line with their underlying business fundamentals. Healthcare is typically considered a defensive sector that holds up relatively well during market volatility, including wartime volatility. The demand for healthcare is relatively inelastic. People don't stop needing medical care because of geopolitical tension, and healthcare companies' revenues are therefore less sensitive to the economic disruptions that conflict can produce. Gold, the ancient safe haven and its modern reality. Gold's reputation as the ultimate safe haven asset during conflict and crisis is so deeply embedded in popular financial culture that questioning it feels almost iconoclastic. But the historical record on gold during conflict periods is more nuanced than the reputation suggests, and getting it wrong can be expensive. Gold has genuinely performed well during specific conflict scenarios, particularly those involving currency, debasement, hyperinflation, or the kind of systemic institutional breakdown that makes financial asset ownership uncertain. When governments finance wars by printing money, the resulting inflation tends to benefit gold. When the stability of financial institutions is genuinely in question, gold's status as a tangible asset outside the financial system provides real refuge. But gold has also performed poorly during many conflict periods where these specific conditions didn't materialize. During World War II, gold was fixed in price by the Bretton Woods system, providing essentially no crisis premium. During the Gulf War of 1991, gold was largely flat while equity markets recovered. During the first years of the war in Afghanistan and Iraq in the early 2000s, gold moved for reasons more related to dollar weakness and monetary policy than to the conflicts themselves. The honest assessment of gold as a wartime investment. It's a hedge against specific outcomes, currency debasement, financial system instability, hyperinflation, that are realistic in some conflict scenarios and not in others. It's not a reliable general-purpose wartime safe haven that protects against all conflict-related financial disruption. Investors who buy gold because there's a war without specifying which gold-friendly outcome they're hedging against may find that gold does nothing particularly useful for their portfolio during the specific conflict they're worried about. Gold's role in a portfolio is better understood as a small allocation, 5% to 10%, that provides some protection against tail risks, including but not limited to wartime currency and financial system disruption, rather than as a significant tactical allocation to be increased dramatically when geopolitical tensions rise. Government bonds, the safety that isn't always safe. Government bonds, particularly U.S. Treasury bonds, are the classic safe haven asset that investors flee to during periods of uncertainty. The flight to quality is a real phenomenon. When equity markets sell off during geopolitical events, Treasury bonds often rally as investors seek the perceived safety of government-backed debt. But the wartime behavior of government bonds is complicated by the fiscal reality of conflict. Wars are expensive, and governments typically finance them through a combination of increased taxation, borrowing, and money creation. Each of these financing mechanisms has different implications for government bondholders. Increased taxation is bond neutral. It reduces the government's need to borrow without affecting the money supply or inflation. Increased borrowing increases the supply of government bonds, which tends to push bond prices down and yields up, the opposite of what bond investors want. Money creation, the most historically common wartime financing mechanism, creates inflation that erodes the real value of fixed income investments, which is genuinely destructive to bondholders. The U.S. experience during major conflicts illustrates this complexity. During World War II, the Federal Reserve artificially suppressed interest rates to help the government finance the war cheaply. Bond yields were kept below inflation rates for years, meaning bondholders experienced negative real returns. The safety of Treasury bonds during this period meant losing purchasing power reliably and slowly. The practical implication: short-duration government bonds provide genuine near-term stability during acute crisis periods. Long-duration government bonds are exposed to the inflation and interest rate increases that prolonged wartime financing can produce. During geopolitical uncertainty, shortening bond duration, moving from long-term to short-term bonds, is a more intelligent adjustment than simply increasing bond allocation. Commodities, the most direct wartime investment. Physical commodities, oil, natural gas, agricultural products, metals, have some of the most direct and mechanically explicable relationships with conflict periods of any asset class, because wars frequently disrupt the production, transit, or availability of commodities in ways that directly drive price increases. The oil relationship is the most documented. Conflicts in or near oil-producing regions consistently cause oil price spikes. The 1973 embargo, the Iranian Revolution of 1979, the Gulf War, the Iraq War, the Russian invasion of Ukraine, each produced significant oil price movements. Energy price increases flow through the entire economy, increasing costs for transportation, manufacturing, and heating, which increases inflation broadly. Agricultural commodities respond when conflicts affect major producing regions. The Russia-Ukraine conflict disrupted a region that collectively produces a significant percentage of global wheat, corn, and sunflower oil exports. Agricultural commodity prices spiked sharply, with real consequences for food security and import-dependent countries. Industrial metals, aluminum, copper, nickel, respond to supply disruptions, production facility damage, and the increased demand that military production generates. The Russia-Ukraine conflict disrupted nickel production sufficiently to cause historic short-term price volatility. For investors, commodity exposure during conflict periods can be accessed through commodity ETFs, commodity producer equities, or futures-based products. Each has different risk characteristics. Physical commodity ETFs provide direct commodity price exposure. Commodity producer equities add company-specific operational risk on top of commodity price exposure. Futures-based commodity products involve roll costs that can significantly drag returns over time. A modest commodity allocation, through a diversified commodity ETF or energy and materials sector exposure within equities, provides genuine portfolio protection during the supply disruption scenarios that conflict most reliably produces. Chapter 3. The geographic dimension. Where you're invested matters as much as what you're invested in. Here's the investing variable that gets the least attention in wartime investing discussions and may matter the most: geography. Where your investments are located, which countries' economies and companies you own stakes in, determines your exposure to conflict-related disruption more directly than any asset class decision. A perfectly diversified equity portfolio concentrated in a country that is directly involved in a major conflict will underperform a less sophisticated portfolio concentrated in a country that is geographically distant from the same conflict. The quality of your stock selection is secondary to the geography of the market you're selecting from when the conflict is severe enough to produce real economic damage in specific regions. The home bias problem in wartime. Most individual investors exhibit what behavioral economists call home bias, a tendency to concentrate investment in domestic markets beyond what diversification principles would suggest. For investors in major developed economies, the United States, the UK, Western Europe, Australia, home bias has historically been a tolerable error because the home market is large, liquid, and well-diversified across sectors. But home bias becomes a more serious risk when the home country is directly involved in or significantly economically affected by a major conflict. European investors with home-biased portfolios experienced significantly more wartime disruption during the Russia-Ukraine conflict than U.S. investors, because European markets had greater direct exposure to the conflict's effects. Energy price increases, supply chain disruption, refugee costs, increased defense spending requirements. The general principle: the further your investment portfolio is geographically from an active conflict, the less directly your portfolio performance will be affected by that conflict. This sounds obvious when stated directly. In practice, it means that genuine geographic diversification, owning meaningful stakes in markets across multiple regions rather than concentrating in one country or region, is a structural wartime protection that costs nothing to implement and provides resilience against exactly the kind of regionally concentrated disruption that conflicts produce. The U.S. market's unique geopolitical position. The United States occupies an unusual position in global geopolitical and financial dynamics that makes U.S. markets a historically resilient destination for global capital during periods of international stress. This position is worth understanding explicitly. The U.S. dollar is the world's primary reserve currency, the currency in which most international trade is denominated, most commodity prices are set, and most international debt is issued. During periods of global uncertainty, capital tends to flow toward the dollar and dollar-denominated assets, including U.S. Treasuries and U.S. equities, as a safe haven. This capital inflow tends to support U.S. asset prices during periods when other markets are experiencing outflows. The U.S. is geographically isolated from most of the world's active conflict zones by two oceans and diplomatically aligned with the world's other major military powers. Its physical productive capacity, its factories, infrastructure, technology, agricultural land is not directly threatened by most realistic conflict scenarios. Its energy position has improved dramatically through the shale revolution, making it significantly less vulnerable to energy supply disruptions than it was during the 1973 oil crisis. None of this means U.S. markets are immune to wartime disruption. A conflict that threatens global energy supplies, disrupts global trade patterns, or produces significant inflation would affect U.S. markets meaningfully. But it does mean that U.S. market exposure provides a degree of geopolitical resilience that exposure to markets closer to active conflict zones doesn't. The emerging market complication. Emerging market investments, stocks and bonds of companies and governments in developing economies, present a specific wartime challenge that deserves explicit attention. Many emerging markets are in regions of elevated geopolitical risk. They're also more dependent on commodity exports, more vulnerable to capital outflows when global risk sentiment deteriorates, more exposed to currency depreciation when the dollar strengthens, and less institutionally resilient to the economic and political disruptions that conflict can produce. During periods of global geopolitical stress, emerging market assets have historically experienced significant underperformance relative to developed market assets. The capital outflow from emerging markets to safe havens during stress periods is well documented and can be dramatic. Currency depreciation, bond yield spikes, and equity market declines can all happen simultaneously in a self-reinforcing cycle. This doesn't mean emerging market exposure should be zero in a wartime-aware portfolio. Emerging markets provide diversification, exposure to faster-growing economies, and commodity-related returns that can actually be positive during the supply disruption scenarios that conflicts create. But the appropriate allocation to emerging markets during elevated geopolitical stress periods is likely lower than the allocation appropriate during stable periods, and the geographic composition of that emerging market exposure, avoiding markets most directly affected by nearby conflicts, matters significantly. Identifying geographic exposure in your portfolio. Here's the practical challenge that makes geographic diversification harder to implement than it sounds. Most investors don't actually know their portfolio's geographic exposure because the relationship between where a company is listed and where it derives its economic activity is complex and often counterintuitive. A US-listed company may derive 60% of its revenue from international markets. A UK-listed company may have its primary operations in Asia. A company listed in one country may have supply chains running through conflict zones, creating indirect geographic exposure that doesn't appear in the company's home listing. For ETF investors, who hold funds rather than individual stocks, the geographic exposure of a total U.S. market fund includes companies with global revenue streams that are partially exposed to international geopolitical dynamics despite being U.S. listed. The FAANG-era technology giants are global businesses whose revenue depends on the stability of internet infrastructure, international commerce, and advertising markets across dozens of countries. The practical implication: understanding your geographic exposure requires looking beyond where your funds are listed to where the underlying businesses generate their economic activity. This is more work than most investors do, but it's the analysis that actually reveals your real exposure to specific conflict scenarios rather than the surface-level exposure that fund names suggest. For most investors, the pragmatic approach is maintain broad diversification across U.S. and international developed markets, reduce exposure to markets directly affected by active conflicts, and recognize that even a U.S.-focused portfolio has meaningful international exposure through the global revenue streams of major U.S. companies. The diversification imperative. Here's the through line of this entire chapter. Geographic diversification is the most reliable structural defense against wartime portfolio disruption available to ordinary investors, and it's available at essentially no cost through broad international index funds. A portfolio that owns the entire world through a combination of US total market and international total market funds, is inherently more resilient to any single conflict's regional impact than a portfolio concentrated in the region affected by that conflict. No single war destroys the global economy. Wars destroy specific regions, specific supply chains, specific industries. A globally diversified portfolio is exposed to those destructions only in proportion to the affected region's weight in the global economy. This is not a guarantee of protection. A conflict large enough to disrupt the global economy broadly, a major power conflict involving nuclear threats, or a conflict that disrupts global trade routes or energy supplies sufficiently to cause worldwide recession, would affect a globally diversified portfolio significantly. But for the range of conflicts that have actually occurred in the modern era, global diversification has provided exactly the protection its advocates claim. Own the world. Let the non-affected parts of the world carry the portfolio through the periods when specific regions are disrupted. This simple structural decision is worth more than most of the tactical adjustments that wartime investing discussions focus on. Chapter 4. The Wartime Portfolio. What to actually do with your money right now. We've established the historical context. We've toured the asset classes. We've addressed the geographic dimension. Now comes the chapter that most people skipped to when they started this video and then went back to watch the earlier chapters because they realized they needed the context first. What do you actually do with your portfolio when the world is at war? The answer has several layers, and the layers matter. The right response depends on your specific situation, your time horizon, your current allocation, your geographic exposure, your income stability, and the specific nature of the conflict you're concerned about. But there are general principles that apply broadly, and there are specific tactical adjustments that the historical record supports making versus ones that feel prudent but produce worse outcomes. Let's go through them systematically. Layer 1. Do less than you think you should. Here's the first and most important layer of the wartime portfolio response, and it's the one that will frustrate people who came here looking for specific action items. The correct response to most geopolitical conflict escalation is to do significantly less than your instincts are telling you to do. The instinct during conflict escalation is to act, to protect, to reduce exposure to the uncertainty, to move to safety before the situation gets worse. This instinct is understandable, human, and, if acted on in the specific ways it typically manifests, historically counterproductive. We established in Chapter 1 that the investors who do worse during geopolitical events are almost universally the ones who sold during the initial panic and failed to reinvest before the recovery. The action that feels protective is, in most conflict scenarios, the action that locks in losses and misses recoveries. The inaction that feels irresponsible is, in most conflict scenarios, the action that captures the full long-term return of the market. This doesn't mean complete passivity. There are legitimate evidence-based adjustments worth making during periods of elevated geopolitical stress. But the baseline, the starting point before any adjustments, should be maintaining the portfolio you had before the conflict escalated, rather than dramatically restructuring it in response to fear. The specific reason to start with less action, rather than more. The adjustments that feel most urgently necessary during acute geopolitical stress are almost always the most expensive ones. Selling equities when they've already declined to buy bonds or gold at elevated prices is a buy high, sell low transaction, disguised as risk management. The urgency to act is a feature of the emotional state the conflict has produced, not a feature of the financial situation that requires a response. Layer 2. The legitimate adjustments. Within the baseline of doing less than your instincts suggest, there are specific portfolio adjustments that the historical record supports making during periods of elevated geopolitical stress. These are modest, directional adjustments, tilts rather than complete portfolio restructuring, that improve the portfolio's resilience to conflict-related disruptions without abandoning the long-term investment strategy. Adjustment 1. Modest defensive sector tilt. Increasing exposure to sectors that have historically outperformed during conflict periods, defense and aerospace, energy, materials, and reducing exposure to sectors most vulnerable to conflict-related disruption, consumer discretionary, international tourism, luxury goods, is a historically supported adjustment. The key word is modest. A tilt from the market weight allocation to a modest overweight in defense and energy represents a directional improvement in wartime resilience, without concentrating the portfolio in a way that creates large sector-specific risk. How to implement? Within an equity portfolio, this might mean adding a small allocation to a defense sector ETF, ITA, iShares US Aerospace and Defense ETF, or XAR, SPDR S&P Aerospace and Defense ETF, alongside the Broad Market Index Fund Core, or simply checking whether your current broad market allocation already provides meaningful defense and energy exposure, which most total market index funds do in proportion to those sectors' market capitalization. Active reweighting may be less necessary than it feels. Adjustment 2. Commodity exposure increase. A modest increase in commodity exposure through a diversified commodity ETF like PDBC or DJP, or through increased allocation to energy and materials sector equities, provides direct exposure to the supply disruption price increases that conflict most reliably produces. The size of this adjustment should be proportionate to the conflict's likely impact on specific commodity markets. A conflict directly affecting oil-producing regions justifies more energy commodity exposure than a conflict in a region with limited commodity significance. Adjustment 3. Bond duration reduction. If your portfolio includes significant long-duration bond exposure, wartime is a reasonable time to shorten duration. Long-duration bonds are most vulnerable to the inflationary pressures that wartime financing can produce. As inflation rises and interest rates rise with it, long-duration bond prices fall. Short-duration bonds and money market instruments provide stability without the inflation sensitivity. This adjustment is particularly relevant if the conflict is producing visible inflationary pressure in energy or food prices that is likely to feed through to broader inflation. Adjustment 4. Geographic rebalancing away from directly affected regions. If your international equity allocation has significant exposure to markets directly affected by the conflict, European markets during the Russia-Ukraine conflict, for example, a modest reduction in that specific geographic exposure and reallocation to less directly affected regions is a supported adjustment. This is not wholesale abandonment of international diversification, which remains a valuable structural feature of the portfolio, but a modest reduction in the specific geographic exposure most directly in the line of the conflict's economic fire. Adjustment 5. Cash and liquidity increase. Increasing the cash component of the portfolio through short-term treasury bills, money market funds, or high-yield savings accounts provides two benefits during geopolitical stress periods. It reduces overall portfolio volatility during the acute uncertainty phase, and it creates dry powder, investable capital available to deploy when valuations improve during or after the conflict. In 2026's interest rate environment, cash equivalents offer meaningful yields, making the opportunity cost of holding more cash smaller than it was during the near-zero rate environment of the 2000s. Layer 3. The things that feel right but are wrong. Here's the equally important layer, the specific actions that feel like intelligent wartime portfolio management, but have consistently produced poor outcomes in historical conflict periods. Wrong action. 1. Selling all equities and moving to cash. The nuclear option of wartime portfolio management, converting equity positions entirely to cash in response to conflict escalation, has historically been one of the most expensive decisions available. It combines locking in any current losses with missing the recovery that follows in most conflict scenarios, plus the psychological trap of not knowing when to reinvest. The investor who sold everything in September 2001, in March 2003, or in February 2022 and waited for stability before reinvesting paid an enormous cost in missed returns. Complete equity liquidation is only defensible in scenarios where the conflict poses a realistic, direct threat to the fundamental value of the equities being sold, which for most investors in developed market equities is not the realistic scenario. Wrong action 2. Concentrating heavily in gold. Gold's status as the go-to wartime safe haven is so culturally embedded that investors consistently over-allocate to it during conflict periods, buying at elevated prices after the safe haven premium has already been priced in. A 5% to 10% gold allocation is a reasonable structural portfolio feature. Increasing gold to 20%, 30%, or more of the portfolio in response to conflict news, which is when everyone else is buying gold and prices are already elevated, is buying insurance. After the house has already started burning at the highest possible premium, the expected return on gold purchased at crisis-elevated prices is significantly lower than the expected return on gold purchased as a structural allocation before the crisis. Wrong action 3. Trying to trade the conflict. The instinct to trade around conflict events, buying defense stocks on escalation news, selling on de-escalation news, timing entries and exits around specific geopolitical developments is almost universally more expensive than a buy-and-hold approach. The information required to trade conflict developments profitably, accurate prediction of escalation and de-escalation timing, knowledge of which specific economic mechanisms will be activated, understanding of how each development will be priced by the market, is not available to ordinary investors and is barely available to the most sophisticated geopolitical analysts. The bid-ask spreads, capital gains taxes, and timing. Errors produced by active conflict trading consistently eat returns that patient inaction would have preserved. Wrong action. 4. Moving entirely to domestic assets. The instinct to invest in what you know and retreat from international diversification during periods of global uncertainty reduces the very geographic diversification that provides structural resilience to regionally concentrated conflict disruption, unless the specific conflict poses a direct threat to international developed market assets broadly, rather than to specific regions. Reducing international diversification makes the portfolio more sensitive to domestic economic conditions at precisely the moment when domestic conditions may themselves be affected by the conflict. The specific portfolio for different investor types. Here's where the general principles translate into specific portfolio configurations based on different investor situations. For the beginning investor, under 35, long time. Horizon, portfolio. Under $100,000, the wartime portfolio adjustment for a beginning investor is minimal. The time horizon is long enough that even a significant conflict-related market disruption, a 30% to 40% decline sustained for 2 to 3 years, resolves to a positive outcome in the longer view. The contribution rate, the consistent monthly addition to the portfolio, is the most powerful determinant of outcomes at this stage, not allocation optimization. Specific adjustments worth making. Ensure the portfolio is globally diversified through a combination of U.S. total market and international developed market index funds. Continue automatic contributions regardless of market conditions. The lower prices during conflict-related declines mean contributions buy more shares. Consider whether your emergency fund is fully funded, 3 to 6 months of expenses in a high-yield savings account, because financial resilience during income disruption from conflict-related economic slowdown is more important than portfolio optimization. What not to do: don't pause contributions because the market is declining. Don't move the portfolio to cash or bonds because the news is frightening. Don't concentrate in defense stocks or gold because they're the current conversation. The long-time horizon is your primary asset, and protecting it means staying invested. For the mid-career investor, 35 to 50, growing portfolio, increasing financial obligations. This is the investor for whom the modest tactical adjustments discussed above are most relevant. The time horizon is still long enough to absorb significant downturns, but the portfolio is large enough that significant declines have real dollar consequences, and the financial obligations, mortgage, children's education, career transition considerations, make resilience more important than for a younger investor. Specific adjustments worth making. Ensure the portfolio is genuinely diversified across sectors and geographies, with meaningful but not excessive exposure to defense, energy, and materials. Consider a modest increase in the cash and short-duration bond allocation from perhaps 10% to 15% to 20%, to provide a buffer against the income disruption that conflict-related economic slowdown could produce. Review your specific geographic exposure to ensure you're not inadvertently concentrated in markets most directly affected by the conflict. Ensure all relevant insurance coverage, life, disability, home, is current and adequate. For the pre-retirement investor, 50 to 65, portfolio approaching its peak. The pre-retirement investor has the least tolerance for sustained conflict-related market disruption, A significant portfolio decline in the 5 to 10 years before retirement can meaningfully affect the sustainability of the retirement income plan. The sequence of returns risk, the risk of experiencing major losses just before beginning to draw down the portfolio, is at its highest in this period. Specific adjustments worth making. If the current conflict produces significant and sustained market stress, this is the investor for whom reducing equity allocation somewhat, from perhaps 70% to 60%, is most defensible. Ensuring a meaningful allocation to short-duration bonds, Treasury inflation-protected securities, TIPS, and cash equivalents provides both stability and inflation protection against the wartime inflationary pressures that long-duration bonds don't offer. The buffer of 2 to 3 years of planned retirement spending in stable assets, the bucket strategy, provides resilience against being forced to sell equities at depressed prices during a conflict-related market decline. For the retired investor, drawing down the portfolio, the retired investor's primary wartime concern is sequence of returns risk, the specific danger of drawing down a portfolio that is simultaneously declining. The mitigation strategy is the bucket approach, maintaining 1 to 2 years of living expenses in cash or cash equivalents, 2 to 4 years in short-duration bonds, and the remainder in a diversified equity portfolio. The cash and bond buckets provide income during conflict-related equity market declines without requiring equity sales at depressed prices. The retired investor should also review whether their withdrawal rate, the percentage of the portfolio being withdrawn annually, remains sustainable under conflict-related scenarios. A 4% withdrawal rate has strong historical support, but assumes diversification, inflation adjustment, and the absence of extreme sustained market disruption. If the conflict is producing significant inflation, as wartime conflicts often do, the real value of a nominally fixed withdrawal can erode more quickly than planning assumptions anticipate. Chapter 5. The Defense Sector Deep Dive. How to Invest in the Industry That Profits from Conflict. Here's the chapter that requires a brief acknowledgement before diving in. Investing in defense companies is ethically complex in a way that other sector investments aren't, and the complexity is worth naming honestly, rather than glossing over in the rush to discuss returns. Defense companies make weapons. Those weapons are used in wars. Some of those wars are defensive and justified by reasonable international legal and ethical standards. Some are not. When you invest in a defense company, you're providing capital to an enterprise whose products are used to kill people, and the fact that those products are also used to protect people doesn't make the moral complexity disappear. Different investors resolve this complexity differently, and this video respects that diversity of resolution. Some investors choose not to invest in defense companies regardless of the return profile, and that's a legitimate choice. Some invest without reservation, on the grounds that national defense is a necessary function that requires industrial capacity. Many are somewhere in the middle, uncomfortable with direct investment in specific weapon systems, but willing to accept defense exposure within broad market index funds. Whatever your resolution, this chapter provides the information needed to make an informed decision, the financial mechanics of defense sector investing, the historical return profile, and the specific vehicles available. The ethical dimension is yours to navigate. Why defense stocks perform. During conflict periods, the financial mechanics of defense sector outperformance during conflict escalation are straightforward enough that understanding them requires no special expertise. Defense companies, Lockheed Martin, Raytheon Technologies, Northrop Grumman, General Dynamics, L3Harris in the US, BAE Systems, Leonardo in Europe, Rheinmetall, Thales on the continent, derive their revenue primarily from government contracts. The primary customer is the government's Defense Department, and the Defense Department's budget is directly affected by geopolitical conditions. When geopolitical tensions rise, governments increase defense budgets. When defense budgets increase, defense companies receive more orders, more contracts, more revenue. The order books lengthen, the revenue visibility improves, the earnings outlook strengthens. And because equity valuations are partly driven by earnings expectations, the strengthening outlook drives stock prices higher. The relationship is not perfectly linear. Contract awards have long lead times, budget appropriations involve legislative processes, and international export sales introduce additional variables. but the directional relationship between geopolitical tension and defense sector performance is reliable enough to be one of the more robust sector relationships in geopolitical investing. The Russia-Ukraine conflict provides the most recent, vivid illustration. European defense stocks, Rheinmetall, BAE Systems, Leonardo, Thales, experienced dramatic outperformance beginning with the conflict's escalation in February 2022. Rheinmetall, the German ammunition and tank manufacturer, increased in value by several 100% over the subsequent 2 years as Germany and other NATO members dramatically increased defense spending. The financial mechanics, more government spending, more orders, more revenue, higher earnings, were exactly as described. The defense ETFs, the diversified approach. For investors who want defense sector exposure without selecting individual companies, defense-focused ETFs provide a diversified approach to the sector. ITA, iShares, U.S. Aerospace and Defense ETF, is the largest and most liquid U.S. defense ETF, holding a portfolio of U.S. aerospace and defense companies including Raytheon, Lockheed Martin, Northrop Grumman, L3 Harris, and others. The expense ratio is 0.40%, which is higher than broad market index funds but reasonable for a sector ETF. The concentration in U.S. defense primes makes it most responsive to U.S. defense budget increases. XAR, SPDRS, and P Aerospace and Defense ETF tracks the S&P Aerospace and Defense Select Industry Index, which uses an equal weight methodology rather than the market cap weighting of ITA. This gives more relative weight to smaller defense companies, which may have more upside in specific conflict scenarios but also more volatility. DFEN, Direxion Daily Aerospace and Defense Bull 3X Shares, is a leveraged ETF that attempts to deliver 3 times the daily return of the Aerospace and Defense Index. This is emphatically not a vehicle for most investors. Leveraged ETFs decay in value over time due to the mathematics of daily compounding, and they're appropriate only for very short-term tactical use by sophisticated investors who fully understand the decay mechanism, mentioning it here to warn against it rather than recommend it. For European defense exposure, which has been particularly notable in the post-Ukraine conflict environment as European NATO members dramatically increased defense budgets, EUAD, VANEC Defense, UCITS ETF, and ASWC, Wisdom Tree Europe Defense, UCITS ETF, provide specific European defense sector exposure that US-focused ETFs don't. NATO, the Invesco Aerospace and Defense ETF with broader international exposure, provides a more globally diversified defense portfolio that captures both U.S. and international defense spending trends. The Defense Investment Thesis in 2026. Here's the specific investment thesis for defense sector exposure in the current environment, stated plainly with its supporting logic and its specific risks. The supporting thesis: global defense spending is in a multi-year structural increase that is unlikely to reverse quickly, regardless of the resolution of specific conflicts. The post-Cold War peace dividend. The sustained reduction in defense budgets that followed the Soviet Union's collapse is definitively over. NATO members are increasing spending toward the 2% of GDP target that most had been missing for decades. European rearmament is a generational realignment of defense spending that creates sustained order flow for defense companies. Middle Eastern defense spending is elevated. Indo-Pacific defense spending, Japan, South Korea, Australia, is increasing in response to perceived Chinese military ambitions. The secular direction of global defense budgets is upward for the foreseeable future. Defense companies in this environment have high order backlog visibility. Contracts signed today generate revenue for years, improving pricing power as demand exceeds production capacity, and government customers who pay reliably and don't disappear in recessions. The sector combines the growth characteristics of a defense budget expansion cycle with the defensive revenue reliability of government contracts. The risks. Defense spending is politically and diplomatically sensitive. A significant peace agreement or diplomatic breakthrough that reduces the perceived threat environment could cause rapid derating of defense stocks. Defense companies are dependent on specific government procurement decisions that can be delayed, canceled, or reduced by budget pressures or political changes. Export sales are subject to government approval and geopolitical considerations that create revenue uncertainty. The valuations of defense companies have already increased significantly in the post-2022 environment, meaning some of the spending increase may already be priced into current stock prices. The balanced assessment, a modest allocation to defense sector exposure through ITA or a comparable ETF, representing perhaps 3% to 7% of the equity portfolio, captures the structural defense spending trend without creating excessive concentration in a sector that is already partially priced for favorable conditions. Larger allocations increase the bet on the specific scenario where defense spending continues to exceed current expectations, which may or may not be correct. Individual defense companies, the specific players. For investors who want to understand the specific companies rather than accepting ETF-level diversification, here's a brief overview of the major defense players and their specific investment characteristics. Lockheed Martin is the world's largest defense contractor by revenue, with primary revenue from the F-35 fighter jet program, the largest defense acquisition program in history, along with missiles, space systems, and rotary wing aircraft. The F-35 has decades of production and support revenue visibility. The risks include program delays, cost overruns, and the political sensitivity of the U.S. government's largest single procurement. Raytheon Technologies, recently rebranded as RTX, combines defense, electronics, missile systems, and Pratt & Whitney aircraft engines. The missile systems business has experienced extraordinary demand following the Ukraine conflict, which has consumed Western missile inventories at a rate that requires years of production to replenish. The commercial aerospace exposure through Pratt & Whitney provides some revenue diversification beyond pure defense. Northrop Grumman has significant exposure to nuclear programs, the B-21 Raider stealth bomber and nuclear missile modernization, space systems, and electronics. Nuclear modernization is a multi-decade U.S. government commitment that provides very long-duration revenue visibility. The space business provides exposure to both defense satellite programs and commercial space. General Dynamics combines defense, combat vehicles, submarines, munitions with Gulfstream business jets, providing some commercial aviation exposure alongside defense. The submarine program, the Columbia-class, nuclear submarine replacement, is a generational program with decades of production ahead. Rheinmetall, the German defense company, has become one of the most discussed defense investments in the post-Ukraine environment. Germany's dramatic reversal on defense spending, from decades of budget constraint to substantial increases in the wake of the Russian threat, has transformed Rheinmetall's order book. Its ammunition, artillery, and armored vehicle businesses are in extreme demand. The concentration in European ground warfare systems makes it more geographically specific than U.S. defense primes. The defense investing caution. Here's the honest caution about defense sector investing that the enthusiasm for the sector's recent performance can obscure. The best time to increase defense exposure was before the sector's dramatic outperformance, not after. Rheinmetall's stock had already increased several 100% by the time most retail investors were discussing adding defense exposure to their portfolios. U.S. defense ETFs had already moved significantly from their pre-conflict levels. Buying defense exposure after the sector has already priced in the defense spending increase means buying the remaining upside, which may be significant or may be limited depending on whether actual spending exceeds what's already priced in, while accepting the full downside if defense spending disappoints or peace breaks out unexpectedly. This doesn't mean defense exposure is now a bad idea. The structural spending increase thesis remains intact. It means the risk-reward calculation has changed from what it was before the sector's run, and the position sizing should reflect that change calculation rather than the obvious opportunity framing that post-performance narratives tend to produce. The defense sector investment, like all investments, is most valuable when made before the narrative becomes consensus and prices have fully adjusted. In the current environment, defense is a sector with a strong structural tailwind that is partially but not fully priced. A reasonable but not obviously exceptional investment opportunity, sized accordingly. Beyond defense, the war economy sectors. Defense is the most obvious wartime sector, but it's not the only sector that benefits from conflict conditions. The war economy is broader than the weapons manufacturers, and understanding the full scope identifies additional portfolio positioning opportunities. Cybersecurity companies benefit directly from wartime conditions because cyber warfare has become a central element of modern conflict. State-sponsored cyber attacks on critical infrastructure, military systems, and civilian targets require defensive cybersecurity capabilities that governments and corporations spend heavily on during elevated threat periods. Companies like CrowdStrike, Palo Alto Networks, and the broader cybersecurity sector have experienced increased demand during periods of elevated geopolitical tension. Intelligence and surveillance technology, satellite imagery, signals intelligence, data analytics for security applications has seen significant government investment growth driven by geopolitical competition. Companies like Palantir, Maxar Technologies, and specialized government technology contractors participate in this growing segment. Shipbuilding and naval systems have experienced renewed attention as naval force projection capabilities become more valued in an era of great power competition. Companies involved in naval construction and maintenance benefit from the naval buildup occurring across multiple countries. Military logistics, supply chain management, and field services, the unglamorous but essential support infrastructure for military operations, represents a large and growing budget category that supports companies in transportation, logistics technology, and field services. Energy. Infrastructure and LNG, liquefied natural gas, companies benefited dramatically from Europe's rush to replace Russian pipeline gas with alternative supplies. The infrastructure required to import, process, and distribute LNG, terminals, tankers, pipeline connections, required massive investment that created significant business opportunities for energy infrastructure companies. The war economy, broadly defined, is distributed across multiple sectors of the economy. A portfolio that includes meaningful allocations to energy, materials, cybersecurity, and diversified industrials, alongside a specific defense allocation, is more broadly positioned for the range of wartime economic impacts than a portfolio concentrated only in traditional defense names. Chapter 6. Inflation, Currency, and the Hidden Wartime Tax on Your Wealth. Here's the wartime financial threat that gets the least attention relative to its historical damage. Inflation. Not market declines, not market sector rotation, not geopolitical uncertainty premium. Inflation, the sustained increase in the general price level that wars have produced with remarkable consistency throughout history, is the mechanism through which wars most reliably and most persistently destroy the real wealth of investors who aren't positioned for it. The relationship between war and inflation is not coincidental, it's structural. Wars cost money, enormous amounts of money, typically far exceeding what governments can raise through taxation alone. The gap between war costs and tax revenue is financed through borrowing and, historically, through money creation. Money creation increases the money supply without a corresponding increase in goods and services, which produces inflation. The more money created, the more inflation. The longer the war, the more money created. The post-World War I hyperinflation in Germany is the extreme case, so extreme it's almost counterproductive to cite because it seems too exceptional to be a useful reference. But milder versions of the same mechanism have appeared in virtually every major conflict in modern history. U.S. consumer price inflation averaged over 6% annually during World War II. The Korean War produced a significant inflationary episode. The Vietnam War-era inflation was partly conflict-financed. The post-2022 global inflation surge, while multifactorial, had meaningful contributions from the supply disruptions and energy price shocks associated with the Russia-Ukraine conflict. Understanding wartime inflation, what causes it, how it affects different asset classes, and how to position against it, is therefore one of the most practically important elements of wartime investing. How wartime inflation destroys wealth. Inflation destroys wealth through a mechanism that's simple to describe and genuinely corrosive to experience. It reduces the real purchasing power of money and fixed income assets. A dollar that could buy a certain basket of goods in 2022 buys less of that basket in 2024 because inflation has raised the price of everything in the basket. The dollar still exists. It's just worth less in real terms. For investors, the specific damage depends on what you're holding. Cash, Money sitting in a checking account or low-yield savings account loses purchasing power at exactly the inflation rate. If inflation is running at 7%, your cash loses 7% of its real value every year. There's no nominal loss, the number in your account doesn't decrease, but the real loss is genuine and cumulative. Fixed-rate bonds are similarly damaged. A bond paying 3% annual interest in an environment of 7% inflation is generating a negative real return of approximately 4% per year. The coupon payments and principal are nominal, fixed in dollar terms, so inflation erodes their real value year by year. Long-duration bonds, which commit the holder to receiving fixed payments for many years, suffer the most. Equities have historically provided better inflation protection than cash or bonds, for a reason that's worth understanding. Companies can, over time, raise prices for their products and services in response to inflation. The nominal revenue and earnings of businesses increase with inflation, which means the nominal value of equity ownership tends to increase with inflation as well. The inflation protection isn't perfect. High inflation also increases costs, compresses margins, and reduces consumer real purchasing power in ways that hurt corporate earnings. But it's significantly better than the protection provided by cash or fixed-rate bonds. Real assets, physical commodities, real estate, infrastructure, and assets with revenues linked to inflation provide the most direct inflation protection because their values and income streams are inherently connected to the price level rather than fixed in nominal terms. The inflation-resistant portfolio. Building inflation resistance into a wartime portfolio requires deliberate attention to the mix of assets held, specifically Treasury inflation-protected securities, TIPS, are U.S. government bonds specifically designed to provide inflation protection. The principal value of TIPS adjusts with the Consumer Price Index, meaning that both the principal and the interest payments increase with inflation. TIPS don't provide strong real returns in normal environments. Their yields are typically lower than nominal treasuries, but they provide exactly the protection that nominal bonds don't when inflation rises unexpectedly. In a wartime portfolio concerned about inflationary pressures, a meaningful allocation to TIPS, perhaps replacing a portion of nominal bond allocation, is a specifically targeted and mechanically sound adjustment. TIPS are available directly through treasurydirect.gov or through ETFs. SCHP, Schwab US TIPS ETF, STIP, iShares 0 to 5-year TIPS Bond ETF, and VTIP, Vanguard Short-Term Inflation Protected Securities ETF, provide convenient liquid access to TIPS exposure. Short-duration TIPS, held in funds like STIP or VTIP, are particularly appropriate for wartime positioning because they're less sensitive to interest rate changes while maintaining the inflation linkage. Commodity exposure provides inflation protection through the direct price mechanism. Commodity prices rise with inflation, often leading it in wartime scenarios where supply disruptions are the inflationary driver. Energy commodities, agricultural commodities, and industrial metals all have histories of rising during inflationary episodes, particularly those driven by supply disruptions of the type that conflicts produce. A diversified commodity ETF, PDBC, COMT, or similar, captures this exposure across commodity categories without concentration in any single commodity. Real estate, through REITs, provides inflation protection through the combination of rising property values and rising rents, both of which tend to track inflation over time. REITs in sectors with short lease durations, apartment REITs, hotel REITs, industrial REITs, can reprice their income streams quickly as inflation rises, providing more timely inflation protection than REITs with long-duration leases. Infrastructure investments, utilities, pipelines, toll roads, airports, often have revenues linked to inflation through regulatory frameworks or contract terms, providing relatively direct inflation pass-through to investors. Infrastructure ETFs like IGF, iShares Global Infrastructure ETF, or IFRA, iShares US Infrastructure ETF, provide diversified infrastructure exposure. Equities in inflation-benefiting sectors, energy producers, mining companies, agricultural businesses, provide inflation protection through the commodity price mechanism combined with operational leverage. These companies' revenues rise with commodity prices, while their fixed costs grow more slowly, amplifying the inflation benefit at the earnings level. The currency dimension of wartime investing. Here's the wartime financial variable that most investors in developed countries rarely think about until it becomes an acute problem: currency. Specifically, the risk that the currency in which your investments are denominated, and the currency in which you'll ultimately spend your wealth, loses value relative to other currencies during and after a conflict. Currency depreciation is a consistent feature of wartime economies for the same reasons that inflation is. Money creation to finance war increases the money supply, which reduces the currency's value relative to currencies whose supply isn't being expanded. The currency of a country financing a major war with money creation depreciates. The more money created, the more depreciation. If your wealth is entirely denominated in the depreciating currency, the real value of your wealth measured in international purchasing power declines. The US dollar's status as the global reserve currency provides significant protection against this mechanism for American investors. In most crisis scenarios, capital flows toward the dollar rather than away from it, providing a counterintuitive appreciation pressure during periods of global stress. But this protection is not unlimited or permanent. A conflict large enough to call into question the United States' fiscal sustainability or geopolitical dominance would create dollar depreciation pressure that even reserve currency status couldn't fully offset. For investors in currencies with less reserve currency status, European currencies, emerging market currencies, currencies of countries directly involved in conflicts, the depreciation risk is more immediate and more severe. The Russian ruble's behavior following the invasion of Ukraine, dramatic initial depreciation, partial recovery through capital controls and energy export revenues, illustrates the range of outcomes possible for a conflict-involved country's currency. Currency diversification, holding some portion of wealth in assets denominated in strong foreign currencies, provides protection against home currency depreciation. For U.S. investors, this is naturally achieved through international equity exposure, which holds assets denominated in foreign currencies. For investors in more vulnerable currencies, deliberate allocation to dollar-denominated or other hard currency assets provides more explicit protection. Gold serves a currency protection function in extreme scenarios. It's denominated in no country's currency and therefore provides protection against any single currency's depreciation. This is the most legitimate and historically supported use case for gold in a wartime portfolio, as protection against the specific scenario where the home currency depreciates significantly due to wartime money creation. Practical inflation-proofing checklist. Here's the specific checklist of actions that address wartime inflation risk in a portfolio, ordered by priority. First, ensure your emergency fund is in a high-yield savings account earning competitive interest. In an inflationary environment, cash sitting in a zero-yield checking account is losing real value rapidly. Even a 4% to 5% high-yield savings rate doesn't fully offset significant inflation, but it reduces the real value loss substantially. Second, review your bond allocation for duration. Long-duration bonds are the most vulnerable to inflation-driven interest rate increases. Shorten duration by moving from long-term to short-term bond funds and replace a portion of nominal bond exposure with TIPS. Third, ensure meaningful commodity exposure. Energy, materials, and agricultural commodities provide direct inflation protection through price-level linkage. Fourth, maintain substantial equity exposure. Equities are imperfect but genuine inflation hedges over medium to long horizons. Fifth, for investors particularly concerned about currency risk, either because they're in a vulnerable currency or because they hold significant cash, consider deliberate allocation to gold ETFs, GLD, IAU, or hard currency assets. Chapter 7. Psychological Survival: How to Keep Your Head When Everyone Around You is Losing Theirs. Here's the dimension of wartime investing that technical portfolio construction guides consistently underweight: the psychological challenge of maintaining investment discipline when the news environment is producing maximum fear, maximum uncertainty, and maximum pressure to do something, anything, to protect yourself from what feels like an unprecedented threat. The psychological difficulty of wartime investing is not a character flaw, it's a rational response to genuinely threatening circumstances, processed by a brain that evolved to respond to threats with immediate action. The news environment during conflict escalation, the continuous stream of alarming updates, the expert commentary emphasizing downside risks, the social media amplification of fear, creates a psychological environment in which the disciplined investment behaviors that produce good long-term outcomes feel reckless, and the panicked behaviors that produce poor outcomes feel responsible. Understanding the specific psychological mechanisms at work and the specific defenses against them is therefore as important as understanding the portfolio mechanics. The availability heuristic and conflict-driven fear. The availability heuristic is a cognitive bias that causes people to assess the probability of events based on how easily examples come to mind, how mentally available they are, rather than based on statistical frequency. Vivid, recent, emotionally impactful events are more mentally available than mundane, distant, or emotionally neutral ones, so their probability gets systematically overestimated. Wartime news coverage is a sustained, high-intensity delivery of mentally available examples of conflict-related catastrophe. Every day of conflict, news makes scenarios of economic collapse, market devastation, currency failure, and social disruption more mentally available, easier to bring to mind, more vivid in imagination, more emotionally weighted in decision-making. The result: investors experiencing intensive wartime news coverage systematically overestimate the probability of conflict-related financial catastrophe. They overweight the tail risk scenarios, the hyperinflation, the market collapse, the institutional breakdown, relative to the historical base rate, which shows that most conflicts produce temporary disruption followed by recovery rather than permanent catastrophic damage. The defense against the availability heuristic: deliberately and regularly expose yourself to historical base rate information, the actual record of how markets have responded to conflicts, to counterbalance the vivid present tense coverage making catastrophic scenarios feel inevitable. Chapter 1 of this video is the antidote to the availability heuristic. When conflict news is making catastrophe feel certain, go back to the historical data. The data is the reality check that recalibrates the distorted probability assessments that fear produces. The action bias in wartime portfolio decisions. Action bias is the well-documented tendency to prefer action over inaction even when inaction produces equal or better outcomes. The feeling that doing something is more responsible than doing nothing, regardless of whether the action is helpful. Action bias is particularly damaging in investing contexts because the highest quality investment behavior, staying invested, maintaining allocation, continuing automatic contributions, is structurally passive. It looks like doing nothing. In normal times, this passivity is psychologically difficult enough. During wartime, when the pressure to act is intense and sustained, maintaining productive passivity becomes extraordinarily hard. The financial advisor industry has a term for the value of preventing clients from making emotionally driven portfolio changes: the behavioral alpha. The research, notably from Vanguard's Advisors Alpha studies, consistently finds that the primary value an advisor provides to many clients is not superior investment selection or sophisticated allocation management. It's preventing clients from making expensive behavioral mistakes during stress periods. The behavioral alpha, the return improvement from not panic selling during downturns, is consistently estimated at 1% to 3% per year, which compounds into enormous differences in long-term outcomes. For investors without advisors, the behavioral defenses that substitute for this function include the investment policy statement discussed in earlier chapters, the pre-decided response to market declines, the deliberate reduction in portfolio checking frequency during conflict periods, and the cultivation of perspective through historical reading rather than news consumption, the specific reframe that combats action bias. Redefine doing something to include the active choice of maintaining discipline. Staying invested isn't passivity, it's the active execution of a deliberate, evidence-based strategy in the face of significant pressure to abandon it. The investor who checks the news, feels the fear, consciously chooses not to sell, and goes about their day has made a significant and valuable decision. It just doesn't look like one. Managing the doom-scrolling investment cycle. Here's a specific behavioral pattern that wartime investing creates, and that is worth naming explicitly, because naming it is the first step to breaking it: the doom-scrolling investment cycle. The cycle runs like this. Conflict news creates anxiety. Anxiety creates the urge to monitor the situation, to stay informed about developments that might require a response. Monitoring produces more conflict news, which creates more anxiety. More anxiety increases the frequency and intensity of monitoring. The portfolio gets checked more often. Each check during a declining market produces additional anxiety. The anxiety accumulates. Eventually, the accumulated anxiety produces a selling decision. I can't take it anymore. That locks in losses at exactly the wrong moment. The doom-scrolling investment cycle is the behavioral mechanism through which excellent, thoughtful, financially literate investors make terrible decisions that they recognize as terrible only in retrospect. It's not stupidity. It's the interaction of normal human anxiety with a news environment designed to maximize engagement by maximizing anxiety. The breaks in the cycle that prevent the worst outcomes. Reduce news consumption frequency during conflict periods. Not to zero. Staying informed has genuine value, but to specific, limited windows rather than continuous monitoring. Set specific times for news consumption, perhaps once in the morning and once in the evening, and actively resist checking outside those windows. The military situation in an active conflict is unlikely to change in ways that require your immediate investment response in the hours between news checks. Separate portfolio monitoring from news consumption. If you're going to check the news, don't simultaneously open the brokerage app. The combination of conflict news and portfolio performance together creates maximum anxiety pressure. Consuming them separately, news at one time, portfolio review at scheduled quarterly intervals, reduces the emotional intensity that drives poor decisions. Cultivate the long-term perspective actively rather than passively. Read about previous conflict periods and market recoveries. The histories are the instructive and available. Engage with personal finance communities that emphasize long-term thinking. Discuss your investment approach with a trusted partner or friend who can provide the external perspective that internal anxiety makes difficult. The specific self-talk that prevents panic selling. Here's the specific internal monologue, the things to tell yourself during the moments of peak anxiety that the most experienced and successful long-term investors use to maintain discipline during periods of maximum stress. I'm not selling because the price has gone down. I'm selling the same underlying asset, ownership of productive businesses, that I decided was worth holding before the price changed. This reframe, separating the price from the asset, is the core of value investor thinking and the core of wartime investment discipline. The price has changed. The underlying asset, the productive capacity of businesses, the compounding engine of the global economy, has not changed in proportion to the price change. The decision to hold isn't based on the current price. It's based on the long-term value of the underlying asset, which is determined by its productive output over time, not its trading price today. Every major conflict in modern history has eventually ended. Every major market decline in modern history has eventually recovered. I am investing on those historical probabilities, not on the possibility that this time, uniquely among all conflicts, produces permanent catastrophic economic destruction. This reframe grounds the decision in the base rate rather than the vivid present. The current conflict feels uniquely dangerous. Every conflict has felt uniquely dangerous to the people living through it. The base rate of recovery is the relevant statistical reference, not the vividness of the current fear. If I sell now and the market recovers, I'll have captured the loss and missed the recovery. Getting back in requires knowing when the recovery has begun, which I don't know, and which no one reliably knows. This reframe makes the cost of the potential error concrete. Selling isn't costless. It creates a decision problem that's harder than the original holding decision, when to reinvest, that most investors resolve by waiting too long and missing the recovery. Chapter 8. The Energy Transition Paradox: War, Oil, and the Clean Energy Complication. Here's the investing complexity that 21st century wartime creates that previous generations of investors didn't have to navigate. The simultaneous pressure of war-driven fossil fuel demand and the ongoing energy transition toward renewables, pulling investment opportunities in apparently contradictory directions at the same time. The Russia-Ukraine conflict illustrated this paradox vividly. On one hand, the conflict created an urgent demand for alternative fossil fuel supplies. Europe scrambled to replace Russian pipeline gas. With LNG, coal plants were temporarily reopened, and energy security became the overriding policy priority in ways that pushed clean energy transition timelines backward. Oil and gas stocks surged. fossil fuel investment, which had been under sustained ESG-related pressure, suddenly looked strategically essential. On the other hand, the same conflict created powerful political and strategic arguments for accelerating the clean energy transition. If European countries could generate their own electricity from solar and wind, they would never again be vulnerable to energy supply weaponization by an adversarial state. The conflict simultaneously strengthened the short-term case for fossil fuels and the long-term case for renewables. For investors, this paradox creates genuine decision complexity, and understanding it clearly is essential to positioning the energy component of a wartime portfolio intelligently. The short-term fossil fuel case. Here's the short-term investment case for fossil fuel energy during active conflict, stated as clearly as possible. Wars that involve major energy-producing regions or that create credible threats to energy supply routes cause energy prices to rise. Rising energy prices directly increase the revenue and profitability of fossil fuel producers. The operating costs of existing fossil fuel production don't increase proportionally with the energy price. They're largely fixed. So the profit margin expansion from higher energy prices is significant. The earnings of oil and gas companies in a high-price environment are often dramatically higher than in a low-price environment, which drives stock price appreciation. Additionally, the energy security imperative created by conflict-driven supply disruptions causes governments to accelerate domestic fossil fuel development and LNG infrastructure investment. Contracts for LNG export terminals, pipelines, and new drilling programs are awarded. The investment spending creates multi-year revenue streams for energy companies that persist beyond the immediate price spike. In 2026's environment, with multiple active conflicts affecting or threatening to affect energy markets, the short-term fossil fuel investment case remains intact. Energy sector exposure, through broad energy ETFs like XLE or specific LNG infrastructure names, provides both inflation protection and direct wartime demand exposure. The long-term clean energy case. Here's the long-term investment case for clean energy that the same conflicts simultaneously strengthen. Every conflict that demonstrates a country's vulnerability to fossil fuel supply disruption creates political and strategic motivation for that country to reduce its fossil fuel dependence. Europe's post-Ukraine experience, the economic pain of Russian gas dependence, and the scramble to replace it has created generational political commitment to domestic clean energy development that will drive substantial investment for decades. The strategic arguments for clean energy independence, not having to import fuel from potentially adversarial or unstable regions, generating energy domestically from inexhaustible sunlight and wind, are made more compelling by exactly the supply weaponization episodes that conflict creates. Defense of energy supply is a national security imperative that justifies substantial public investment and policy support. Clean energy companies, solar manufacturers and installers, wind turbine producers, battery storage manufacturers, grid modernization technology providers, hydrogen infrastructure developers are the long-term beneficiaries of this structural shift. The investment case isn't primarily about wartime performance. It's about the decade-long deployment of trillions of dollars of investment into energy transition infrastructure, driven partly by energy security imperatives that conflict makes urgent, the pragmatic energy. Portfolio resolution. Here's the resolution to the paradox that serves most wartime investors intelligently. Hold both, in proportion to time horizon. For the wartime portfolio's short-term energy exposure, the component addressing current price pressures and supply disruption risks, conventional energy sector exposure is appropriate. XLE, VDE, or specific LNG and energy infrastructure names provide this exposure. This component is positioned for the near-term energy price dynamics that conflict creates. For the wartime portfolio's long-term energy exposure, the component positioned for the structural transition that conflict accelerates, clean energy ETFs provide it. ICLN, QCLN, INRG, or broader clean technology funds like CTEC provide exposure to the companies building the energy infrastructure of the next several decades. The two-component energy approach captures the short-term wartime fossil fuel dynamics while maintaining exposure to the long-term transition. That those same wartime dynamics are accelerating. The relative weighting between them should reflect the investor's time horizon. A younger investor with a 30-year horizon should weight the transition more heavily, while an older investor primarily concerned with near-term portfolio resilience should weight conventional energy more heavily. The critical materials dimension. Here's the clean energy wartime connection that most investors haven't thought through carefully. The clean energy transition is intensely materials intensive, and many of the materials it requires, lithium, cobalt, nickel, rare earth elements, copper, are concentrated in specific geographic regions that are subject to the same geopolitical pressures as fossil fuel supply. Lithium for batteries is concentrated in the lithium triangle of South America and in Australian deposits. Cobalt is heavily concentrated in the Democratic Republic of Congo. Rare earth elements critical for wind turbines and electric motors are dominated by Chinese production. Nickel production, critical for battery chemistry, was significantly disrupted by Russian supply concerns following the Ukraine conflict. Copper, essential for electrification infrastructure, is concentrated in politically complex regions of South America and Africa. The energy transition's material dependencies create a new category of supply vulnerability that conflicts can exploit, different from fossil fuel supply weaponization, but structurally similar in its economic mechanism. A country that controls a critical battery material supply chain has a form of economic leverage over countries dependent on that supply that's analogous to fossil fuel supply leverage. For investors, this creates an interesting positioning opportunity. Companies involved in critical materials mining, processing, and recycling, and companies working to develop alternative material sources, reduce material intensity, or establish secure supply chains for transition materials are positioned at the intersection of wartime supply security concerns and clean energy transition dynamics. ETFs like REMX, VanEck Rare Earth and Strategic Metals ETF, LIT, Global X Lithium and Battery Tech ETF, or COPX, Global X Copper Miners ETF, provide access to these dynamics in diversified form. Chapter 9. The Complete Wartime Investing Checklist. Everything you need to do in order. This chapter is the distillation of everything in this video into a specific actionable checklist, the exact steps to take, in priority order, to position your portfolio intelligently during wartime and periods of elevated geopolitical stress. No vague principles. No consider your risk tolerance hedging. Specific actions, specific instruments, specific order. Use this as the reference you return to when the news is making everything feel urgent and you need a calm, systematic guide to what actually matters and what order it matters in. Step 1. Assess your emergency fund, the pre-investment foundation. Before making any portfolio adjustments in response to geopolitical stress, ensure your emergency fund is intact and fully funded. 3 to 6 months of essential living expenses in a high-yield savings account, not invested, not in a money market fund that requires liquidation, but in an FDIC-insured savings account that you can access immediately. The reason this comes first: conflict-related economic disruption can affect income through job losses, business disruption, reduced hours, or sector-specific downturns. The emergency fund is what prevents income disruption from forcing you to sell investments at the worst possible time to cover living expenses. A fully funded emergency fund is more valuable than any specific portfolio adjustment during geopolitical stress because it removes the scenario where financial need forces portfolio decisions at inopportune moments. In 2026's interest rate environment, a high-yield savings account paying 4% to 5% is not a meaningful sacrifice relative to invested alternatives for the emergency fund component. The liquidity and security of the fund takes priority over its return. Step 2. Review and confirm your investment policy statement. Before making any portfolio changes, review your written investment policy statement, the document that specifies your target allocation, rebalancing rules, and commitment to maintaining discipline during downturns. If you don't have one, write it now while you're reading this video with a clear head before the next acute anxiety moment arrives. The investment policy statement should specify your target allocation by asset class and geography, your rebalancing rules, your committed response to market declines of various magnitudes, and, critically, the specific conditions that would justify a genuine portfolio allocation change versus the conditions that should be met with discipline. And inaction. Reviewing the statement before making any changes creates a deliberate pause between the impulse to act and the action itself, a pause in which the decision is measured against the pre-committed framework rather than against the emotional state of the moment. Step 3. Review geographic exposure, identify concentrations, examine your current portfolio for geographic concentration in markets directly affected by the conflict. Look beyond fund names to underlying holdings. A European equity fund holds significant exposure to companies operating in or near conflict zones. An emerging market fund may have exposure to countries facing conflict-related secondary effects. Identify specific geographic concentrations and assess whether they represent risk levels beyond what your investment policy specifies. A modest reduction, not elimination, of exposure to the most directly affected regions is a supported adjustment. Move the reduced allocation to U.S. total. See market, global, ex-U.S. developed market, or short-term bond instruments depending on your overall allocation targets. Step 4. Bond duration reduction, the inflation defense. If your portfolio contains significant long-duration bond exposure, long-term treasury funds, corporate bond funds with average duration above 5 years, reduce duration toward the short end of the curve. Replace long-duration bond exposure with short-duration alternatives. VGSH, Vanguard Short-Term Government Bond ETF, SHY, iShares 1 to 3 year Treasury Bond ETF, SCHZ, Equivalent Short Duration Funds, or BIL, SPDR Bloomberg 1 to 3 month T-bill ETF for near cash stability. Replace a portion of nominal bond exposure, perhaps 30% to 50% of total bond allocation, with TIPS. Use VTIP or STIP for short-duration TIPS exposure that provides inflation protection without long-duration interest rate risk. This step doesn't eliminate bond exposure. Bonds still provide portfolio stability, but restructures it for the inflationary environment that wartime financing tends to produce. Step 5. Modest defensive sector. Tilt, energy, defense, materials. Review your current sector exposure within equities. If you hold broad market index funds, check whether your existing allocation already provides meaningful energy, defense, and materials exposure. Most total market funds do, in proportion to these sectors' market capitalizations. If additional defensive sector tilt is appropriate for your situation, implement it modestly. A 3% to 5% allocation to a defense ETF, ITA, or XAR, a 2% to 4% additional allocation to energy beyond the market weight, XLE or VDE, and consideration of a 2% to 3% material sector tilt, XLB, or a diversified commodity ETF like PDBC. The combined defensive sector tilt should represent no more than 10% to 15% of the total equity allocation. Beyond this level, the sector concentration creates idiosyncratic risks that outweigh the wartime. Positioning benefit. Step 6. Commodity exposure. The inflation and supply disruption. Hedge add or confirm commodity exposure through a diversified commodity ETF. PDBC, Invesco Optimum Yield. Diversified commodity strategy. No K1 ETF provides broad commodity exposure without the tax complexity of a K1 form. DJP, IPath Bloomberg Commodity Index, Total Return ETN, is an alternative. For energy-specific commodity exposure, USO, United States Oil Fund, or UNG, United States Natural Gas Fund, provide targeted exposure, though with the roll-cost characteristics of futures-based products that require understanding before using. The commodity allocation should represent 3% to 7% of the total portfolio, enough to provide meaningful inflation protection and supply disruption exposure without creating dangerous concentration. Step 7. Modest gold allocation, the tail risk. Hedge confirm. A modest gold allocation, 3% to 7% of the total portfolio, as a tail risk hedge, against the specific scenarios where currency debasement, financial system instability, or institutional breakdown would damage paper asset values. If gold has recently surged in price due to conflict-driven buying, be aware that some of the protection premium may already be priced in, and resist the instinct to increase the allocation dramatically at elevated prices. Implement gold exposure through physical gold ETFs, GLD SPDR Gold Shares, or IAU, iShares Gold Trust, rather than gold mining stocks, which add company-specific operational risk on top of gold price exposure, or leveraged gold products, which are speculative instruments unsuitable for structural portfolio hedging. Step 8. Continue automatic contributions, the most important step. Ensure your automatic contribution schedule is unchanged and running. 401k payroll deductions continuing, Roth IRA automatic monthly transfers running, taxable account automatic investments on schedule. These contributions are buying assets at whatever price the market offers, and conflict-related market declines mean contributions are buying more shares at lower prices, which is mathematically favorable for long-term outcomes. The automatic contributions are the most important mechanism for wartime investing success because they prevent the timing problem when to invest from becoming a decision that fear influences. The decision was made in advance, is executing automatically, and requires only the discipline of not overriding it. Step 9. Reduce portfolio monitoring frequency, the behavioral defense. Deliberately reduce how often you check your portfolio. Set a specific review schedule, monthly at most, quarterly preferred, and remove the easy access to daily portfolio checking. Delete the brokerage app from your phone if daily checking is a habit. The information value of daily checks is negligible for a long-term investor. The behavioral cost of daily checks during conflict-driven market volatility is significant. Replace the time spent portfolio checking with time spent reviewing the historical data on conflict and markets, the information that calibrates probability assessments correctly rather than amplifying them in the wrong direction. Step 10. Do not deviate from the plan. Without a predetermined justification. The final step is the commitment step, the decision that all the other steps are premised on. Do not make portfolio changes beyond those specified in your investment policy statement without a specific, predetermined justification. Not, the news is scary. Not, everyone seems to be selling. Not, this feels different from previous conflicts. A specific, articulable, evidence-based reason that you would have accepted as sufficient justification before the conflict began. The predetermined justifications for genuine portfolio changes beyond the modest adjustments above, a direct, credible threat to the physical, productive capacity of the economies you're invested in, realistic evidence of institutional breakdown that fundamentally threatens property rights and capital ownership in your invested markets, specific, credible information about inflationary mechanisms, not general concern about inflation, but specific evidence of money creation at rates consistent with historical hyperinflationary episodes. Everything short of these specific thresholds is managed with the checklist above and continued investment discipline. The threshold for genuine major portfolio restructuring is high for a reason, because the historical record shows that the actions taken at that threshold are almost always premature, expensive, and regretted. Chapter 10. The mistakes that will cost you everything. Wartime investing errors and how to avoid every single one. Here's the uncomfortable truth about wartime investing that optimistic guides tend to gloss over. The most financially damaging decisions most investors will ever make happen during exactly the kind of geopolitical stress periods this video is addressing, not during normal markets, not during routine corrections. During the periods of maximum fear, maximum uncertainty, and maximum news intensity that wars and major conflicts create, the mistakes aren't made by stupid people. They're made by intelligent, engaged, financially literate investors who are processing genuine threat information and responding to it with behaviors that feel rational in the moment and look catastrophic in retrospect. Understanding the specific mistakes, the exact sequence of thoughts and decisions that produces each one, is the most reliable defense against making them yourself. This chapter is a complete catalog of wartime investing mistakes, ordered roughly by how commonly they occur and how much they cost. For each mistake, the specific mechanism that makes it feel right at the time, and the specific reframe that prevents it. Mistake 1. Treating the onset of conflict as a signal to sell. This is the most common and most expensive wartime investing mistake, and it happens at the worst possible moment, when the portfolio has already declined from the initial shock sell-off and selling locks in losses at or near the bottom of the conflict-driven decline. The sequence: conflict escalates, markets sell off immediately as uncertainty spikes. The investor watches the portfolio decline and feels the urge to protect what remains. The news coverage intensifies. Expert commentary emphasizes downside risks. Historical analogies to worst-case scenarios circulate. The investor sells to protect against further downside. The market stabilizes as the initial uncertainty is priced in. Recovery begins. The investor, now in cash and waiting for clarity before reinvesting, watches the recovery from the sidelines. Every element of this sequence feels rational at the time. The selling feels protective. The waiting for clarity feels prudent. The staying in cash while watching the recovery feels temporarily uncomfortable but patient. The decision to reinvest only when things feel stable, which happens after significant recovery has already occurred, feels like disciplined re-entry. But the aggregate outcome is sold at the bottom, bought at a recovery high, captured the loss, and missed the rebound. The specific mechanism that makes this mistake feel right. The availability heuristic we discussed in Chapter 7 makes catastrophic outcomes feel highly probable during the vivid present of conflict news. The selling decision is a rational response to a subjectively high probability of catastrophic outcomes, except that the subjective probability is wrong, distorted by the intensity of the information environment rather than calibrated to the actual historical base rate. The reframe: before selling, ask specifically, am I selling because I have specific evidence that this conflict will produce outcomes outside the historical pattern of initial shock and recovery? Or am I selling because the news is frightening and the portfolio is declining and the combination makes action feel necessary? Be honest. The vast majority of selling decisions during conflict periods are the second type, not the first. The second type is expensive. Recognize it, name it, and don't execute it. Mistake 2. Selling and then waiting too long to reinvest. This is the second half of the mistake sequence described above, and it's worth treating separately because it has its own specific psychological mechanism and its own specific cost. The investor who sold during the initial conflict shock faces a new decision problem: when to reinvest. This problem is structurally harder than the original holding decision because it requires predicting not just the direction of the market, but the specific moment when the direction has changed sufficiently to justify re-entry. And the psychological environment in which this decision is made is not the frightened but relatively early environment of the initial sell-off. It's the environment of watching a recovery unfold from the sidelines, which adds the specific anguish of watching the portfolio that doesn't exist anymore increase in value. The response to this anguish is typically one of two forms. Some investors re-enter too quickly, buying back in after a modest recovery, still during the uncertainty phase, only to experience another decline that confirms their worst fears and produces another selling decision. Others wait for complete resolution, for the conflict to end, for the economy to stabilize, for the news to turn genuinely positive, which means waiting until the recovery is almost complete and the next purchase is at or near the post-conflict high. Neither of these re-entry behaviors is cost-free. Both are significantly worse than the outcome from never selling. The reinvestment timing problem is one of the most thoroughly documented sources of investor underperformance, and wartime situations create it in its most acute form. The specific cost. Studies of investor behavior during major market disruptions consistently show that the average investor who sells during a decline and reinvests later achieves returns 1% to 4% below the simple buy and hold return annually. Over decades, this underperformance compounds into retirement portfolio shortfalls of hundreds of thousands of dollars, not from bad investment selection, but from two emotionally driven timing decisions made under stress. The prevention: don't create the reinvestment timing problem in the first place. Staying invested eliminates the problem entirely. But for investors who have already sold, who are already sitting in cash during a conflict period, the practical guidance is: reinvest systematically over a defined period rather than waiting for clarity. Dollar cost average back in over 3 to 6 months, except that you may buy some before the bottom and some after, and that the average price will be reasonable even if no individual purchase is perfectly timed. The systematic reinvestment approach removes the psychological paralysis of trying to identify the perfect re-entry point. which doesn't exist and whose pursuit keeps investors in cash through recoveries they can see happening but can't bring themselves to participate in. Mistake 3. Concentrating in defense stocks after they've already run. Here's the mistake that's specific to wartime investing rather than a general behavioral error: buying heavily into the defense sector after it has already outperformed significantly, motivated by the obvious narrative connection between the conflict and defense company earnings. The narrative is accurate. Defense spending does increase during conflict periods. Defense company earnings do improve. The investment thesis, more government spending, more contracts, more revenue, higher earnings, is mechanically correct. The mistake is not in the thesis, it's in the timing. By the time the conflict defense spending connection is widely understood and broadly discussed, which is by the time most retail investors are implementing it, the defense stocks have already priced in the expected spending increase. The move from pre-conflict prices to post-announcement prices represents the market collectively updating its expectations. The future move, from current prices to whatever prices reflect the actual realized spending, is what investors buying now are positioned for. That future move may be positive if spending exceeds current expectations. It may be negative if spending disappoints or if a peace development reduces the defense budget outlook. The risk-reward calculation is fundamentally different from the calculation that existed before the sector's run, when buying defense was buying underpriced assets ahead of an expected catalyst. After the run, it's buying fairly or expensively priced assets on the hope that the catalyst exceeds what's already been priced in. The specific numbers illustrate the problem. Rheinmetall increased several 100% after the Russia-Ukraine conflict escalation. An investor who bought on the initial escalation news, correctly identifying the defense spending increase thesis before it was consensus, captured extraordinary returns. An investor who bought after seeing the extraordinary returns discussed on financial media, buying the widely understood consensus narrative, paid a price that already reflected the defense spending increase and had limited upside from the consensus scenario. The wartime investing principle this illustrates: the best returning wartime investments are the ones made before the war narrative becomes consensus. After consensus, they're positioned for the upside surprise over consensus, which is a smaller and less certain opportunity. Size positions accordingly, modest allocations that don't create catastrophic downside from a peace agreement or spending disappointment. Mistake 4. Ignoring your own economic exposure to the conflict. Here's a wartime investing mistake that's distinct from the portfolio decisions we've been discussing: failing to assess how the conflict affects your personal economic situation, your income, your employment, your business, your sector, and incorporating that assessment into investment decisions. Your investment portfolio doesn't exist in isolation from your broader economic life. If you work in an industry that is directly damaged by the conflict, tourism in an affected region, export business to a sanctioned country, logistics through a disrupted route, your income is exposed to the same conflict risk as certain of your investments. Holding concentrated investment exposure in the sector that also employs you doubles the concentration risk from a single event. Specifically, an employee of an energy company who also holds significant energy stock in their investment portfolio has doubled their financial exposure to the energy market's wartime dynamics. If the conflict resolves in a way that causes energy prices to decline sharply, a peace agreement, a diplomatic resolution that restores supply, both their employment income and their investment portfolio are simultaneously damaged. The appropriate response: assess your total economic exposure to the conflict, including employment income, before making investment adjustments. If your income is already concentrated in conflict-sensitive sectors, reduce investment concentration in those same sectors. The diversification principle applies to the total financial position, not just the investment portfolio in isolation. If your income is in a conflict-insulated sector, healthcare, education, domestic services, you have more capacity for conflict-exposed investment concentration than someone whose income is directly affected. Mistake 5. Underestimating the duration of wartime economic disruption. Here's the counterpart to the mistake of overestimating conflict severity: underestimating how long the economic effects of a conflict persist beyond the active fighting phase. The initial shock and recovery pattern we described in Chapter 1 applies to acute market reactions, the immediate pricing of conflict risk. But the economic effects of major conflicts, the supply chain disruptions, the inflation, the trade pattern changes, the capital allocation redirections, the demographic and labor force impacts often persist for years or decades after the active conflict has ended. The post-World War II economic reorganization of Europe took a decade or more to produce genuinely stable pre-war economic conditions. The post-Soviet conflicts in Eastern Europe produced economic disruptions that affected regional investment conditions for extended periods. The post-2022 energy transition in Europe, the shift away from Russian gas, is a multi-year, multi-trillion-dollar restructuring of energy infrastructure that will affect energy markets, inflation, and industrial competitiveness throughout the continent for at least a decade. Investors who positioned correctly for the acute conflict phase, buying defense stocks, commodity exposure, short-duration inflation protection, need to reassess whether those positions remain optimal for the post-acute phase when the economic disruption has evolved from sudden shock to sustained restructuring. The post-acute wartime investment environment typically rewards companies with adaptable supply chains and pricing power that can navigate the restructured trade patterns. Sectors benefiting from the post-conflict rebuilding and infrastructure investment. Long-duration assets, equity in businesses with multi-decade productive capacity that benefit from the normalization that eventually follows, and the continued but evolved inflation protection that persistent wartime financing may require for years beyond the conflict's active phase. Mistake 6. Using leverage. During wartime market volatility, here's a mistake that wartime volatility makes specifically dangerous: using leverage, borrowed money, margin accounts, leveraged ETFs, to amplify investment positions during conflict-related market movements. Leverage amplifies both gains and losses. During normal market conditions, leverage increases portfolio volatility in exchange for potentially higher returns. During wartime market conditions, when volatility is elevated, when sharp moves in both directions occur in short succession, when news-driven spikes and declines can be sudden and severe, leverage creates the specific risk of forced liquidation. The mechanism, a leveraged position that declines sufficiently, triggers a margin call, a demand from the broker for additional capital to maintain the position. If the investor doesn't have the capital to meet the margin call, the broker liquidates the position at the current price, which is typically at or near the low of the conflict-driven decline, locking in losses at the worst possible moment. The forced liquidation removes the investor from the position exactly when the position should be held for the subsequent recovery. Wartime volatility is the environment in which leverage kills portfolios. The sudden, sharp declines that conflict news can produce, even if followed by rapid recovery, can trigger margin calls that force liquidation before the recovery. The investor who held a leveraged position through the 2022 Russia-Ukraine initial shock without sufficient margin buffer may have been forcibly liquidated at the February 2022 low, missing the recovery that followed. The recommendation is simple: eliminate or dramatically reduce leverage from the portfolio during periods of elevated geopolitical stress. The volatility premium the market offers during conflict periods, the higher expected returns from buying during conflict-related declines, is best captured with unlevered positions that can be held through the volatility without forced liquidation risk. Mistake 7. Neglecting portfolio rebalancing. During conflict-driven divergence, here's a wartime mistake that is less dramatic than panic selling, but equally costly in a subtler way. Failing to rebalance the portfolio when conflict-driven divergence between asset classes has caused it to drift significantly from the target allocation. Wartime markets frequently produce dramatic divergence between asset class returns. Defense stocks surge while consumer discretionary declines. Energy rallies while technology falls. Commodities spike while long-duration bonds decline. The portfolio that began the conflict period at a carefully considered target allocation can drift significantly within months, ending up with risk concentrations and sector weightings that differ substantially from what was intended. The failure to rebalance this drift is a mistake for two reasons. First, it allows the portfolio to take on more risk in the sectors that have outperformed, buying more defense, energy, and commodities at elevated post-rally prices, and less risk in the sectors that have underperformed, effectively selling technology and consumer equities at depressed prices. This is a systematic buy high, sell low mechanism that operates through inaction rather than active decision. Second, It means the portfolio's risk profile has drifted away from what was designed for the investor's specific situation. Time horizon, risk tolerance, financial obligations, toward whatever risk profile the conflict's market dynamics have randomly produced. The annual rebalancing discipline is the prevention, at a minimum annually, preferably during the conflict period when the divergence is most extreme. Review the portfolio against the target allocation and rebalance toward targets. In tax-advantaged accounts, sell overweight positions and buy underweight ones. In taxable accounts, direct new contributions toward underweight positions to minimize taxable selling. Rebalancing during conflict periods is the systematic, dispassionate implementation of the buy low, sell high principle, selling what has outperformed to buy what has underperformed, executed through the rule-based discipline of returning to target allocation, rather than the emotional judgment of trying to identify what will outperform next. Mistake 8. Failing to distinguish between genuine safe havens and narratively appealing ones. Here's the final mistake in this chapter, and it's one of the most expensive for sophisticated investors who should know better: buying narratively appealing safe havens that don't actually provide the specific protection the narrative claims. During geopolitical stress, narratives develop around specific assets that are presented as providing wartime protection. Some of these narratives have genuine historical support. Others are marketing narratives that exploit the wartime fear environment to sell products with compelling stories but limited actual protective value. Bitcoin has been marketed as digital gold, a store of value that provides protection against currency debasement and institutional instability during geopolitical stress. The empirical record during actual stress periods tells a different story. Bitcoin has historically been highly correlated with risk assets during acute market stress, selling off alongside equities rather than providing the negative correlation that a genuine safe haven provides. During the March 2020 COVID crash, Bitcoin fell sharply alongside equities. During the 2022 risk-off environment associated with war concerns and rate increases, Bitcoin fell dramatically while traditional safe havens held up better. Specific single-country funds marketed as benefiting from wartime investment flows, frontier market funds, specific country ETFs presented as the next safe haven, frequently represent speculative bets on country-specific outcomes that may or may not materialize with limited liquidity and high costs. Actively managed tactical allocation funds presented as able to navigate wartime volatility through expert management with correspondingly high fees have the same well-documented underperformance problem as actively managed funds in normal environments, compounded by the additional claim of geopolitical market timing ability that the evidence consistently fails to support. The genuine safe havens, U.S. Treasury securities, short-duration government bonds, TIPS, physical gold through low-cost ETFs, and the cash equivalents of high-yield savings and money market funds are the boring, widely known, low-cost instruments that have provided genuine protection during actual historical stress periods. The narratively compelling alternatives provide more interesting stories with less reliable actual protection. Stick to the boring safe havens. The boring ones work. Chapter 11. The questions. Nobody asks out loud. The complete wartime investing. FAQ. Here's the reality of wartime investing education that structured guides like this one don't fully address. After absorbing the historical context, the asset class behavior, the portfolio adjustments, the psychological defenses, and the mistake catalog, most people still have a collection of specific, uncomfortable, sometimes politically awkward questions that didn't fit neatly into any chapter. Questions that feel too blunt to ask a financial advisor. Questions that get typed into search engines at 2 a.m. when anxiety is highest and judgment is lowest. Questions that the financial media dances around because answering them directly requires saying things that make people uncomfortable. This chapter is those questions. All of them. Answered directly, without the diplomatic hedging that makes most wartime financial content feel like it was written by someone trying not to offend anyone while simultaneously not saying anything useful. Real questions. Real answers. Plain language. Q. Should I be worried that my bank will fail during a major conflict? This question comes from a completely legitimate anxiety, particularly for investors who have some awareness of wartime banking history which includes bank runs, currency controls, capital controls, and, in extreme cases, nationalization of banking systems. The honest answer has two parts. In most realistic conflict scenarios affecting developed economies with robust regulatory frameworks, deposit insurance, and central bank backstop mechanisms, individual bank failure is a manageable risk rather than a catastrophic one. U.S. bank deposits are insured by the FDIC up to $250,000 per depositor per institution per ownership category. If your bank fails, for any reason, wartime or otherwise, your deposits up to that limit are protected and returned to you, typically within days. The practical precaution: ensure no single bank holds more than $250,000 of your deposits without the benefit of FDIC coverage. If you have more than $250,000 in liquid savings, which is a good problem to have, spread it across multiple institutions or use the account ownership category rules to increase coverage at a single institution. Joint accounts, individual accounts, and retirement accounts at the same institution each have separate $250,000 coverage limits. The more extreme scenario, systemic banking collapse of the type that occurred in Germany during the Weimar hyperinflation or in Cyprus during the 2012 banking crisis, is a realistic concern only in economies experiencing the specific combination of wartime money creation, sovereign debt crisis, and institutional breakdown that those historical episodes involved. For investors in the US, UK, or other major developed economies with independent central banks and strong institutional frameworks, this scenario is a tail risk worth acknowledging and partly hedging against through diversification across institutions, some physical gold holding, and international asset diversification, but not a base case that justifies dramatic behavioral changes. The two-sentence summary: keep your bank deposits within FDIC limits across multiple institutions, maintain your investment portfolio in a separate brokerage account where investments are your property rather than bank liabilities, and recognize that the specific banking collapse scenarios that history records have required very specific institutional conditions that most developed economies are not currently approaching. Q. What happens to my investments if there's a cyber attack on financial infrastructure? This is the distinctly 21st century wartime investing question that didn't exist in previous eras of conflict, and it deserves a serious answer because cyber warfare against financial infrastructure is a documented, real, and increasingly sophisticated form of geopolitical aggression. State-sponsored cyber attacks on financial infrastructure, stock exchanges, payment systems, banking networks, brokerage platforms have occurred and will likely continue to occur during periods of elevated geopolitical tension. Russia has a documented history of aggressive cyber operations against Ukrainian financial infrastructure. North Korea has conducted cyber operations against financial institutions globally. The threat is real. The reassuring reality: the major U.S. financial institutions and exchanges have invested enormously in cybersecurity infrastructure precisely because of this threat. The New York Stock Exchange, NASDAQ, the major clearinghouses, and the large brokerage firms operate with redundant systems, backup infrastructure, and incident response protocols specifically designed to maintain operations or rapidly restore them after cyber incidents. A successful, sustained disruption of major U.S. financial infrastructure would require a level of cyber capability and sustained attack that represents a significant escalation of geopolitical conflict beyond most realistic scenarios short of direct warfare between major powers. In such a scenario, which would be accompanied by many other dramatic developments, financial market access would be among the less immediately pressing concerns. For the more realistic partial disruption scenarios, a temporary exchange closure, a specific institution's systems being compromised, the practical impact on long-term investors is typically a temporary inability to execute transactions, not a loss of the underlying asset value. Your investments exist as electronic records held by the clearinghouse and the brokerage, with multiple redundant backups, not as entries in a single database that a cyber attack could simply delete. Practical precautions: maintain account access information, account numbers, institution contact information, paper statements, in physical form, independent of digital systems that might be temporarily inaccessible. Spread significant investment assets across more than one brokerage institution. Understand how your specific brokerage handles account recovery and asset protection in the event of system compromise. These are reasonable precautions that also protect against non-wartime cyber risks like identity theft and account fraud. Q. Should I move money offshore during a major conflict? Here's the question that financial advisors almost never answer directly because it carries political and legal dimensions that make direct answers professionally uncomfortable, but that a significant number of investors in elevated risk environments genuinely need to think through carefully. For investors in countries that are directly involved in or immediately threatened by major conflicts, not as geographically distant observers, but as citizens of the combatant nations, maintaining some portion of assets in accounts outside the home jurisdiction is a form of diversification against the specific risks of capital controls, currency debasement, and asset seizure that direct conflict involvement can produce. The historical precedents are instructive. During World War II, citizens of occupied European countries who had maintained some assets in neutral Swiss accounts had options unavailable to those whose assets were entirely domestic. During the Russia-Ukraine conflict, Russians with assets in foreign institutions that weren't subject to Russian capital controls had dramatically more financial flexibility than those entirely dependent on domestic Russian financial infrastructure. For investors in countries not directly involved in conflicts, which includes most people watching this video, offshore diversification is a legitimate portfolio feature that reduces home country concentration risk, provides currency diversification, and maintains access to financial systems that might remain functional if domestic systems were disrupted. It is not tax evasion. Properly structured and reported, foreign accounts and international investments are entirely legal and are, in fact, what every internationally diversified mutual fund does on behalf of its investors. The practical implementation for most investors, international diversification through standard brokerage accounts, international index funds, ADRs of foreign companies, or accounts at US-based brokerages that hold international securities, provides the economic benefits of geographic diversification without the complexity of physically maintaining foreign bank accounts. For investors with sufficient assets and genuine concern about home country risk, which is a more serious consideration for investors in countries geographically closer to active conflicts, actual foreign account maintenance may be worth the additional legal and administrative complexity. The legal requirement: U.S. citizens and residents are required to report foreign financial accounts above $10,000 via the FBAR filing, and the FATCA requirements impose reporting obligations on foreign financial institutions holding U.S. persons' accounts. Offshore assets must be reported to the IRS. Failure to report is the illegal part. The assets themselves are perfectly legal, and millions of Americans maintain them legitimately. Q. Is it ethical to profit from war? Here is the question that sits underneath every discussion of defense stocks, commodity positioning, and wartime investment strategy, and that most financial content either ignores entirely or dismisses with a perfunctory acknowledgement before moving on to the return analysis. It deserves a more serious treatment. The honest answer is, it's complicated, and reasonable people with similar ethical frameworks reach genuinely different conclusions. The case that wartime investing profits are ethically unproblematic. Investing in defense companies provides capital to enterprises that are performing a necessary national security function. The defense industry exists regardless of whether individual retail investors choose to invest in it. Withholding retail investment capital from Lockheed Martin does not reduce its production of aircraft or its revenue from government contracts. The weapons it makes protect people as well as harm them. The ethical calculus of specific weapons in specific conflicts depends on judgments about the justness of the conflicts that reasonable people make differently. More broadly, investing in commodity producers who benefit from wartime price increases, or in sectors whose services are in higher demand during conflict periods, doesn't cause the conflict or extend it. The commodity was going to be produced and sold regardless. The return to the investor is a consequence of the conflict, not a contribution to it. The case that wartime investing raises genuine ethical concerns. Capital allocation does matter at scale. When large numbers of investors direct capital toward defense companies, it reduces those companies' cost of capital, making further expansion more economically attractive. It also sends market signals that influence corporate strategic decisions and lobbying behavior. The aggregate effect of investor capital allocation choices is not zero, even if any individual investor's choice is negligible. Additionally, the line between investing in companies that defend people and investing in companies that make weapons used in conflicts of questionable justness is blurry in practice. The same missile system that defends one country may be exported to another country using it in ways that are ethically contested. The ethical provenance of defense investment returns is not as clean as the national security narrative suggests. The resolution this video offers: be honest with yourself about where you draw the line and why, rather than either dismissing the ethical dimension or allowing it to prevent you from making any decision at all. Some investors choose to avoid direct defense company investment while accepting the defense sector exposure that comes with broad market index funds. Others draw no distinction. Both are defensible positions reached through honest reflection. The position that's hardest to defend is the one that hasn't been examined at all. Q. What if the conflict goes nuclear? How do I invest for that? Here's the question that feels too dark to ask out loud, but that a meaningful number of people are genuinely wondering during periods of heightened nuclear threat rhetoric, which have been more frequent in recent years than at any point since the Cold War. The direct answer: there is no investment portfolio that provides meaningful protection against a large-scale nuclear exchange. The economic and physical infrastructure destruction of a major nuclear conflict would be so comprehensive that conventional investment vehicles, stocks, bonds, commodities, even gold, would have limited relevance in the aftermath. The scenarios where nuclear weapons use causes serious regional damage but doesn't escalate to full exchange are a different matter, and we'll address those separately. For the full exchange scenario, the investments that provide the best relative positioning are the same ones that provide general resilience, physical assets, geographic diversification to regions furthest from primary target zones, essential commodities, and the non-financial preparations, food, water, medical supplies, community relationships, that no investment portfolio substitutes for in a genuine civilization-disrupting event. This is not financial nihilism or survivalist fantasy. It's an honest acknowledgement that some scenarios are outside the domain where investment optimization is the relevant response. The 0.01% tail risk of genuine nuclear catastrophe is managed more effectively through political engagement, support for arms control institutions, and basic physical preparedness than through any investment strategy. For the more realistic scenario of limited or tactical nuclear use, a single detonation as a coercive signal, use in a geographically limited theater, or a nuclear incident that doesn't trigger full exchange, the economic effects are severe but not civilizationally terminal. Markets would experience extreme volatility, potentially severe declines, but the historical precedents of extreme market stress, including periods when nuclear exchange was actively threatened during the Cold War, show that markets retained function and eventually recovered. For this scenario, the wartime portfolio, principles in this video apply with greater intensity. Maximum geographic diversification away from affected regions, maximum defensive positioning in stable assets, maximum liquidity, and the psychological discipline to not make permanent decisions in response to temporary, however terrible, events. The honest summary: invest as if civilization will survive because it almost certainly will, while maintaining the non-investment preparations that reduce the cost of the tail risk where it doesn't. The portfolio optimized for nuclear catastrophe that doesn't happen is a reasonable portfolio. The portfolio optimized for nuclear catastrophe that does happen is irrelevant. Optimize for the former. Q. How should I think about my pension or defined benefit plan during wartime? Here's a question that millions of people with pension entitlements, government employees, teachers, military veterans, longtime private sector employees, are legitimately wondering but rarely see. Addressed in wartime investing content that focuses almost exclusively on investment portfolios, defined benefit pensions, promises to pay a specific income in retirement regardless of investment performance, have a different risk profile from investment portfolios during wartime, and understanding that difference is important for total financial planning. Government pensions backed by the taxing power of a stable sovereign, federal employee pensions, state teacher pensions, in financially sound states, Social Security, are among the most secure financial entitlements available. The underlying promise is backed by the government's ability to collect taxes, which persists through most realistic conflict scenarios. The risk to government pensions from wartime conditions is primarily inflationary. A pension promising $3,000 per month in nominal terms loses real purchasing power if inflation runs at 7% annually, even if the nominal promise is kept perfectly. The practical implication: if your primary retirement income is a nominally fixed government pension, your inflation exposure is higher than if your retirement income came from an investment portfolio that you could adjust toward inflation-protecting assets. The wartime inflation protection strategies discussed in Chapter 6, TIPS, commodities, real assets, inflation-adjusting equities, are particularly relevant for pension recipients seeking to protect the real value of supplemental investment savings against the inflationary pressures that wartime conditions produce. Private employer-defined benefit pensions have a more complex risk profile. They're backed by the employer's ability to fund the pension obligation, which depends on the employer's financial health. An employer whose business is directly damaged by wartime conditions, an airline whose routes are disrupted, a manufacturer whose supply chains are destroyed, may face pension funding shortfalls. The Pension Benefit Guarantee. Corporation provides government insurance for private pensions up to specific limits, but that insurance doesn't cover the full promised benefit for high earners or in cases of large-scale pension system stress. For private pension holders, understand your plan's funded status, the ratio of assets to promised liabilities, and your employer's financial health in the context of the specific conflict's economic impacts. A pension from a healthy employer in a conflict-insulated sector is significantly more secure than one from a financially stressed employer in a conflict-affected sector. Q. How do war bonds work, and should I buy them? Here's a historically resonant question that occasionally resurfaces during major conflicts. War bonds. Government debt instruments issued specifically to fund military operations, marketed to civilian populations as a patriotic investment. War bonds were a significant financing mechanism in both world wars. The U.S. sold Series E war bonds during World War II to finance military operations, paying fixed interest rates over defined terms. They served a dual purpose: financing the war effort and removing money from the consumer economy to reduce inflationary pressure during a period of supply constraint. In the contemporary environment, the direct equivalent of war bonds, government debt instruments issued specifically for conflict financing, isn't a product currently offered by major governments in their modern form. What exists instead is the standard suite of government debt instruments: treasury bills, notes, bonds, and TIPS, available through treasurydirect.gov and through ETFs. If a specific war bond product were offered by the U.S. government, the investment consideration would be simple. Compare the yield to alternative government securities of similar duration. War bonds historically paid below market rates. The patriotic premium was real, meaning investors accepted lower returns than alternatives offered. This is a legitimate personal choice, accepting a below-market return as a form of financial support for a policy position, but it's not an investment optimization choice. The Series 1 savings bond discussed in the investing video in this series, inflation-protected, 0% floor, $10,000 annual purchase limit, is the closest current equivalent to a wartime inflation-protected savings instrument, though it isn't marketed as such. In an inflationary wartime environment, I-bonds offer a genuinely useful combination of government backing, inflation protection, and accessible denomination that makes them worth including in the savings component of a wartime-aware financial plan. Conclusion. Let's bring the full picture into focus. You came to this video because the world felt unstable and your money felt vulnerable. That concern was legitimate. Geopolitical conflict does affect financial markets. Wars do create economic disruptions. The risk of ignoring the geopolitical environment entirely and proceeding as if everything is normal is real. But the risk in the other direction, of overcorrecting, of making dramatic portfolio changes driven by fear, of treating conflict news as a signal to abandon the investment strategy that was designed for exactly these kinds of periods, is larger. Historically, consistently, measurably larger. The investors who've done best through wars are not the ones who predicted them most accurately or reacted most quickly. They're the ones who stayed invested, continued contributing, and didn't let fear convert temporary market disruptions into permanent portfolio damage. Here's what we established across this video. The historical record is more encouraging than the fear environment suggests. Markets have recovered from every major conflict in modern history within timeframes that, in retrospect, look short relative to the acute anxiety that felt permanent during the conflict. The initial shock and recovery pattern is the base case, with genuine exceptions only in scenarios of direct physical destruction, sustained supply disruption, or fundamental institutional breakdown, scenarios that investors can specifically identify and specifically respond to rather than blanket portfolio liquidation. Asset class behavior during wartime follows patterns that are understandable and actionable. Defense and energy outperform. Consumer discretionary and long-duration bonds underperform. Commodities provide inflation protection. Gold hedges tail risks specifically rather than providing general-purpose safety. Understanding these patterns allows modest, evidence-based adjustments rather than fear-driven wholesale portfolio changes. Geography matters as much as what you own. Global diversification is the most reliable structural protection against regionally concentrated conflict disruption. The U.S. market's reserve currency advantage provides additional resilience. Emerging market exposure requires review during conflict escalation. Geographic awareness of where underlying businesses derive their economic activity, not just where funds are listed, is the analysis that reveals real exposure. The wartime portfolio is not a completely different entity from the normal portfolio. It's the normal portfolio with modest, specific, evidence-based adjustments, shortened bond duration, TIPS allocation, modest defensive sector tilts, commodity exposure, small gold allocation, reduced geographic concentration in affected regions, modest adjustments, not wholesale restructuring. Inflation is the most persistent and historically significant wartime wealth threat, and it's the one that gets the least specific attention in wartime investing discussions. TIPS, short-duration bonds, commodities, real assets, and equity sectors with pricing power are the inflation defenses that actually work at the portfolio level. The psychological dimension is where most investors' wartime experience is determined. The availability heuristic, action bias, and doom-scrolling investment cycle are the specific mechanisms through which fear converts into expensive mistakes. The investment policy statement, pre-decided response protocols, reduced monitoring frequency, and active cultivation of historical perspective are the specific defenses that prevent those mechanisms from doing their damage. Defense sector investing offers a genuine structural opportunity in a world of rising defense budgets, with the honest caveat that the opportunity was better before the sector's dramatic recent outperformance, that sizing matters more than participation, and that the ethical complexity is real and deserves honest acknowledgement, rather than being glossed over in the enthusiasm for returns. Energy offers a paradox: short-term fossil fuel demand and long-term clean energy transition, both strengthened by the same conflicts, that resolves through a two-component portfolio approach weighted by time horizon. Critical materials sit at the intersection of the two themes, creating a specific and underappreciated investment opportunity in the materials required for a transition that geopolitical stress is simultaneously accelerating and complicating. The complete checklist, emergency fund, investment policy review, geographic exposure assessment, bond duration reduction, defensive sector tilt, commodity exposure, gold allocation, contribution automation, monitoring reduction, and plan discipline provides a specific, ordered, actionable framework for responding to wartime stress without the panic-driven mistakes that destroy long-term wealth. And underlying all of it, the single most important thing to take from this video: the world has been at war somewhere almost continuously throughout recorded human history. The global economy has grown through all of it. The productive capacity of human civilization, the businesses, the technologies, the institutional frameworks that generate economic output, has survived every war in modern history, adapted to every disruption, rebuilt after every destruction, and continued compounding value for investors who stayed invested through all of it. This is not a guarantee. Tail risks are real. Catastrophic scenarios exist and occasionally materialize. The appropriate response to tail risks is the modest, specific hedging that the checklist above provides, not the wholesale abandonment of the investment strategy that makes long-term wealth building possible. Stay invested, Make the modest adjustments, protect against inflation, maintain geographic diversification, keep contributing automatically, reduce the monitoring that amplifies fear without improving decisions. And when the news is at its most frightening, when every headline suggests that this time, uniquely among all the conflicts that have come before, the outcome will be permanently catastrophic. Remember the historical record. The pattern of initial shock and eventual recovery is not wishful thinking. It's the documented experience of investors who lived through conflicts that felt, to them, exactly as unprecedented and existentially threatening as the current one feels to you. They stayed invested, the markets recovered, their wealth compounded. Yours will too.